Markets are ruthlessly efficient at exposing what the weak links are.
Most assets should be able to come back within a month to 2 months if and when the war ends.
War has a momentum of its own.
If this only lasts for, let's say, a month or less, we will be okay. There will be a snapback.
Longer term, there is still that diversification story.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday with stocks down and crude higher, Iranian attacks on energy assets keeping Brent crude in triple digits. As President Trump is delaying his summit with China's Xi Jinping, Chair Powell's Fed is beginning a two-day meeting stuck between a rock and a very hard place.
What you have right now is increasing inflation and decreasing growth projections, which is exactly this stagflationary type of mix that central bankers absolutely hate. David Seif of Nomura yesterday saying, watch the descents, and I think it's a really salient point. 9-3 is what he potentially could expect. How much does this end up being a dovish decision or a hawkish decision to do nothing?
If in doubt, do nothing and say little, and appear to be very non-committal in the news conference. The forecast is where this gets really, really tricky. Finger in the air type stuff. Which way's the wind blowing? I've got no idea how you put a forecast together in a moment like this.
Nonetheless, they have to put out a statement of economic projections, and nonetheless, people are going to read into it much more than maybe some of the participants mean as they put their projections out there, just because how do you know anything? You can expect them to increase their inflation expectations and decrease their growth expectations, which leaves them with a really interesting question of, can they still forecast 1 or 2 rate cuts for the remainder of 2026?
It's another morning on Wall Street, drinking from the fire hose. Headline after headline crossing the Bloomberg this morning. This one notable in the last hour from the defense minister of Israel saying the security chief in Iran has been, quote, eliminated. That headline crossing just moments ago.
This is one of the most important people in Iran in terms of the security, as well as an individual that was sanctioned by the United States in January when it comes to the deadly, brutal crackdown of those protesters, the Iranian people. So this is going to be an incredibly big deal in Israel as well as in the United States as they continue their campaign against this regime.
Brent crude this morning, 102.90, WTI 96. Equity futures attempting to build on yesterday's gains, just about negative by 0.1%. Coming up this hour, we'll catch up with Julian Emanuel of Evercore, with stocks coming off their best day in 5 weeks. The former Deputy National Security Advisor, Victoria Coates, as President Trump demands support for Hormuz. And Tony Wang of T. Rowe Price, as Nvidia sees chip revenue reaching $1 trillion. We begin this hour with our top story. A new wave of Iranian attacks on key energy sites across the Middle East, keeping crude in triple digits. Joining us now is Bloomberg's Jumana Basechi out of Dubai. Jumana, welcome to the programme. A key headline crossing just an hour ago. Annmarie broke it down. An individual we've been tracking for quite a while.
Yeah, well, this would be the most prominent assassination in the Islamic Republic and for Iran since they took out the supreme leader on day 1 of the operation. So you're referring to the killing of Ali Larijani per the Israel defense minister. We're still awaiting confirmation from Iran, of course, but this is a key figurehead, another key figurehead within the regime. He had been appointed to the head of the National Supreme Security Council last August, which means effectively he's been responsible for many of the military and also nuclear decisions on behalf of the Islamic Republic. He was very close to the former Supreme Leader Khamenei and would have been involved as well in many of the military decisions that would have been taken throughout the course of this war that's been going on for 17 days now. Also interesting is that he had been posting post after post messages of defiance. He'd been last seen walking the streets of Tehran on Friday at a pro-government demonstration, sending words of defiance to President Trump, saying to him that it's very easy to start a war with Twitter, but it's not easy to get out of it. And of course, now the IDF and Israeli defense minister saying that they have successfully eliminated him alongside the chief of the Basij, which is the paramilitary force, the paramilitary arm. Again, that is a huge IRGC adjacent group that are responsible for putting down any opposition that emerges to the Islamic Republic and had a very effective role in those brutal crackdown on the demonstrations that we saw at the beginning of this year. So 2 key people eliminated. But at the same time, Iran have continued to be defiant. And you mentioned the strikes on key energy infrastructure. That is ongoing over here in the UAE. It's been another very challenging evening. Residents received a couple of missile alerts throughout the course of the night. The airspace was temporarily halted for a couple of hours. And then it emerged that Iran had also targeted a gas field. This is in quite a remote area of the UAE. It's known as the Shah gas field, responsible for about 20% of UAE gas production. Sulfur specifically, which supplies around 5% of the global sulfur market. Limited operations there now. Another fire, once again, at that key port on the Gulf of Oman, Fujairah, also halting operations there too. And remember, you will recall that a week ago, they also targeted a key refinery in the UAE, the Ruwais refinery, which is also seeing a halt in production. So the blows to energy infrastructure keep incoming. I should say, though, interception rates are high. And a lot of the halt in production we have seen is on back of precautionary measures as opposed to these facilities sustaining a serious amount of damage. But the point is that Iran continues to strike back and on non-US assets.
Jumana Basechi with the latest. Jumana, appreciate your time, as always, over in Dubai. More from Jumana in the next hour. Here's the view on Wall Street this morning. Julian Emanuel of Evercore writing, this is one of the riskiest moments of the 21st century, but betting on the end of the world has been a losing proposition consistently since 1982, and we expect that to be the case once more. Julian joins us now for more. Julian, good morning. Good to see you.
Good morning.
Is that 5% dip a Bible one?
Well, it's actually, the better question is if you
There's
had...
a better question that I want to ask.
There is definitely a better question, John. If we had known that you were going to more than double from the December low in oil to where we got to a week and change ago, and we saw the string of payroll reports that we've seen over the last 6 months, would you have really thought that stocks would only have been down 5%, essentially in a 6-month range? We would have thought the number would be down 15, 20, or 25%. It speaks to the resilience of the market. It speaks to the resilience of the economy. And ultimately, in our view, the fact that you're going to get double-digit earnings growth this year speaks to the fact that markets can move higher.
It's impressive. Some people might say complacent. I would say it's impressive because of the earnings profile. You did some work on this. I read through the research. Just walk through how good earnings are at the moment and traditionally what that means for an equity market going forward.
So, and this is the irony of it, we're projecting 11.1% growth for 2026. And we are below consensus, okay? And when we create those numbers, we like to put out a number where we see symmetrical risk, and we feel good about that. But in fact, when you have had double-digit earnings growth, you've had that 11 times since 1996, 10 of the 11 years, the market has been up. The average is 13%. And that's a very compelling story for us.
I was struck by the split screen. On one hand, we're talking gloom, doom, the end of the world, World War III. And then people were completely wowed by an AI robotic Olaf who came out and could speak and was so cute and everybody was so excited. And Jensen Huang talked about $1 trillion of sales through 2027. Is some of that earnings really being driven by the artificial intelligence, the deployment, et cetera, or is it still broad-based? Is it still on the expectation that the U.S. economy can move through whatever kind of oil shock we experience?
Well, so our work on oil says you're actually at the point where time and price are meeting, and that's why we're seeing this volatility. The market and the psychology can cope with prices in the 90s for a short amount of time. The real break point for the consumer is $4 a gallon in gasoline. We're getting close there. We've seen in the past, whether it was 2022 or 2008, that precipitates economic slowdowns, that precipitates market turndowns. So that's why there is an urgency to sort of moving the narrative. But from our point of view, when you think about earnings power, it really goes back to this idea that productivity has been increasing over the last couple of years for reasons other than AI. And now all of a sudden you're starting to hear much more concrete evidence, which we think will continue to accelerate throughout 2026, about how AI is being used for both cost save and revenue generation.
If we're getting to the point where oil prices start to pressure the consumer and start to pressure just exactly what we're looking at, why is credit not reacting more strongly?
Well, again, credit has gotten a little bit ruffled the last few days, and there's this sort of circular logic. In fact, the hedging in both the equity markets and the credit markets, and in fact to the upside in the oil markets, taking together are as extreme as we've ever seen them. And this, dates back, but I was a youngster on the trading desk in the first Gulf War in the early 1990s, and it wasn't as extreme as this. So I would argue that, number one, again, going back to the earnings profile, going back to the consumer staying steady, it really says that credit is holding in. And in fact, the place where credit is stressed, in high tech, high yield tech, it's really been contained. And again, to the extent that growth continues to look north of 2%, we think it can stay contained.
Julian, is the bigger issue this morning, though, the fact that diesel is above $5 a gallon? We haven't seen that since December of 22, and this has a bigger effect on the economy than just consumers going to the pump.
It certainly is an effect. We'll have to see how that plays out. Obviously, the logistics companies and frankly, when you think about the last couple of months, whether it's a function of speculation or the function of the potential for rising fuel prices, you have seen more volatility in logistics company share prices than we've seen in a lot of other areas. So it's definitely an ongoing issue. But again, I think you're probably still a little bit away, our work says, from the break point where it does dampen economic activity.
We often say in financial markets that markets can shape the events they anticipate. And I think it's good news that we're not getting a material tightening of financial conditions, that you are still seeing capital markets somewhat wide open. We had just yesterday JP Morgan selling nearly $15 billion of debt to back the biggest leverage buyout ever. And how was demand? Pretty decent.
And it really speaks to this idea, again, going back to one of the reasons that the credit markets are as well behaved as they are in general. That particular issuance is really sort of overlooked as a soothing factor, saying that things are still open and there is value being created by this spread widening where people are willing to enter.
Julian, good to see you. As always, a constructive view going forward. Julian Emanuel there of Evercore. The earnings profile is decent and capital markets are still open. That's supportive of risk for now.
Yeah, you could argue that the reason why you're seeing investment grade spreads widen is because the issuance has been just tremendous. And you're seeing the issuance pipeline continue to grow and people come to market and sell bonds, sell loans. So exactly where is the stress coming from? And I think that really gives you the reason for what some people are calling complacency.
Things can change very, very quickly, that's for sure. Equity futures on the S&P negative here by about 0.2%. Let's give you an update on stories worldwide this morning. With your Bloomberg brief, Yahara has more. Hi, Yahara.
Good morning, John. Brent continuing to trade above $100 a barrel as Iran strikes new targets across the Persian Gulf. The UAE suspending operations at the Shah natural gas field due to a fire, while a drone attack temporarily shut the Fujairah ports. An Iraqi oil field and a key Emirati port were also targeted. Meanwhile, President Donald Trump requesting a delay to his summit with his Chinese counterpart Xi Jinping for about a month. The president citing the need to stay in Washington to oversee the Iran war. Trump was scheduled to travel to China from March 31st to April. Teams from the two countries met in Paris in recent days ahead of the summit. And Nvidia CEO Jensen Huang predicting the company's flagship AI processors will generate $1 trillion in sales through 2027. Speaking at the company's biggest annual event, Wang also unveiled a variety of new products and plans to push deeper into central processing units. That's your Bloomberg brief. John.
Yahara, thank you. Appreciate the update, Yahara, there. More from Yahara later on in the hour. Almost forgot, Julian. SEC quarterly reporting. Got to squeeze that in. Can we survive without that? Quarterly earnings.
Look, you want things in general that cause less market volatility, not more. I don't know that it would change investor behavior to that great an extent. Okay. We like frequent reports.
Wanted to squeeze that in. It's good to see you. I know it's important to you. Up next on the program, we'll talk about that a little bit later. Calling for a coalition.
Numerous countries have told me they're on the way. Some are very enthusiastic about it, and some aren't. Some are countries that we've helped for many, many years, and they weren't that enthusiastic.
Up next, we'll catch up with the former Deputy National Security Advisor, Victoria Coates, from New York City this morning. Good morning. Snapping a four-day slide on the S&P 500 in yesterday's session. Back on course for declines this morning. We're down by 0.2% on the S&P, and the Nasdaq down by a third. Pretty marginal stuff, but the inverse correlation between equities and crude sticks. It holds. Check out crude. WTI and Brent up by 3%, 103.36. WTI just short of 97, up by 3 percentage points this morning. Under surveillance this morning, calling for a coalition.
Numerous countries have told me they're on the way. Some are very enthusiastic about it, and some aren't. Some are countries that we've helped for many, many years. We've protected them from horrible outside sources, and they weren't that enthusiastic. We'll protect them, and if we ever needed help, they won't be there for us.
So here's the latest this morning. The president struggling to find a coalition to escort tankers through the Strait of Hormuz. The president also threatening to expand strikes on Kharg Island, Iran's main oil export hub. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, President Trump maintains that the Strait of Hormuz will get going, in his words, quote, very soon, as he reiterated his call for allies to surge assets to the region. But as you heard, it's highlighting what's been past strained relations between the Trump administration and traditional allies when it comes to defense spending. Plus, our own analysts at Bloomberg Economics say that for our European partners in particular, they're constrained by capabilities and politics, but also they risk not acting now to help the Trump administration with the war in Iran could compromise this White House's engagement when it comes to the war in Ukraine. The thing is, at this moment, our allies appear weary at best at meeting the president's demand for naval escorts to go to the Strait. And at this point, we heard from a flurry of leaders, including the German Chancellor Merz yesterday, who said that NATO is a defensive alliance, not an intervention alliance. And the UK Prime Minister Keir Starmer, who appeared to refuse to say whether or not the country would commit resources before a ceasefire is reached. We did hear from President Trump yesterday suggesting that Secretary of State Marco Rubio could soon announce a coalition, though he declined to give further details. John, as you well know, it appears Iran is allowing some vessels to move through the strait, as this morning Iraq confirmed it's currently in negotiations with the country after being one of the first producers to cut output when the conflict began.
Some of those headlines bringing traders a bit of comfort in the last 24 hours. Something to keep on tracking, Tyler. Thank you. Tyler Kendall there outside the White House this morning. To build on this conversation, the former Deputy National Security Advisor, Victoria Coates, joins us for more. Victoria, welcome back to the programme. Let's just recap some headlines. So an hour ago, we got a headline from Israel, a minister from Israel, that the security chief in Iran had been, quote, eliminated. The fate of the supreme leader is still very much unclear at this point. Who is leading the war effort in Iran?
Well, good morning, John. It's very difficult to tell. And the elimination of Ali Larijani, who is essentially their national security advisor, is a huge blow to them. He is a long-term politician. He was the Speaker of their parliament, also deeply involved in their nuclear program, part of a very powerful family, and would have been in contention to be one of the, or a candidate rather, to be supreme leader in the event that Mojtaba Khamenei turns out to have not survived his injuries. So this is a huge blow to the decision making of the Iranian government. Again, another powerful figure. He was marching in the Quds Day parade last Friday. Very active Twitter feed. His pinned tweet is mocking the dignified transfer of our 6 heroes through Dover earlier this month. So this is a very, very big deal, and I think will contribute to the just kind of disintegration of command and control that we've seen in Tehran.
A significant development for sure, Victoria. This morning, coming off the heels of what the president said yesterday, we don't know if he's dead or alive, talking about the supreme leader. Nobody's seen him, which is unusual. Building on Jonathan's point, if the U.S. wants to have discussions with the regime, who do they actually have an outreach to?
Well, again, this is an excellent question. And I think what we may start to see are some lesser known figures who are more kind of career bureaucrats in the Iranian system start to step forward. We'll see if this has the intended effect of getting what's left of the Iranian leadership to reconsider their very hardline positions, and potentially, they will reach out to the Americans to try to make a deal. Another problem they have, Lisa, though, is that they have been they've been attacking systematically all of their neighbors, including countries like Oman and Qatar, who traditionally are interlocutors. They're the negotiators who could be carrying out these discussions. But by very aggressively attacking them, Iran has alienated them. So they're not all that interested in talking to the Iranians either. So the Iranians are in an increasingly difficult position.
When it comes to energy and the flow through the Strait of Hormuz, do you think the president is going in the end to get this coalition together? He voiced a tremendous amount of frustration yesterday with the countries he had previously called upon.
Yes, and this should have happened 10 years ago. I mean, the United States is not dependent on the flow of energy out of the Gulf. The countries who are, countries like China, South Korea, the Europeans, they have to have that energy. We don't. And so the fact that we've been spending billions upon billions of dollars ensuring this safe passage is patently unfair. So this is the kind of capability that these countries should have developed a long time ago. The president's absolutely correct on calling on them to do it. However, the fact of the matter is that particularly for the Europeans, they don't have the kind of the ability to project power, force protection. They haven't been building their navies. And so it's not that Keir Starmer, doesn't want to send a carrier to the Gulf. I don't think he can at this point. I don't think he has the force readiness. I mean, they couldn't even get a destroyer to Cyprus in 10 days at the beginning of the war. So I think we're really exposing a terrible weakness in NATO and something that needs to be addressed long term.
Long term, what does that mean for the future of NATO?
Well, I mean, I think it could be a really good thing for the future of NATO. I think what the president did at the NATO summit last year in The Hague, getting our European allies to commit to that 5% of GDP on defense, was an excellent first step. We need that money to be spent, though. We need those ships to be purchased. And then if they want to protect their national interests, their energy security, then they should be able to deploy them.
Does it make it easier or harder to open the Strait of Hormuz that we have chaos right now in Tehran?
I guess that's sort of a mixed bag. I mean, the more we degrade their ability to fire missiles, the easier it is to open the strait. But that said, one guy with a limpet mine on a small boat can do a lot of damage. So it remains a menace and a nuisance. But the other thing we have that's coming online and it looks like we can expand its capacity are some pipelines that bypass the strait. We have Petroline in Saudi Arabia from Abqaiq to Yanbu, essentially from the Persian Gulf to the Red Sea. That can run, apparently, we thought it was about 5 million barrels a day. It's up around 8 now. So that's not all of the 20 million barrels that usually come out of the Gulf, but it's a big chunk of it. So I think we'll see that pipeline activity expand, and that really, in a way, diffuses the Iranian threat.
Victoria, always good to catch up. It's good to touch base, as always. The former Deputy National Security Advisor, Victoria Coates there. That east-west pipeline, thank goodness the Saudis saw this happening ahead of time.
Right, but the conversations I'm having with people is what if the Houthis get involved in the Red Sea and the Bab el-Mandeb Strait? And if they start attacking ships there, that means that basically that crude that Saudi is banking on going through that pipeline and boarding those ships in the Red Sea, that is going to become another tremendous problem.
And that's been a problem over the last couple of years. Victoria was talking about how exposed two countries are, Japan and South Korea. This from SocGen, the most exposed to Hormuz. They have historically sourced 81% and 62% respectively of their crude from the strait.
This is the reason why you're seeing some of those stocks, some of those assets selling off most significantly, and why some of those governments have taken immediate action to finance some of the increases in cost of living.
Up next on the programme, we'll catch up with Tony Wang at T. Rowe Price as Nvidia announces a $1 trillion forecast. Plus, Yahira has your morning movers, energy stocks rising alongside the rally in crude. Snapped a 4-day losing streak on the S&P 500 in yesterday's session. Equities dipping 5% from all-time highs, and that dip got bought briefly. Now we declined by 0.25% on the S&P, and the Nasdaq down by 0.3. If that's where stocks are, you can guess where crude is. This is where crude is right now. WTI and Brent closing above 100 for a third consecutive session, adding to it this morning, up by 3%. Brent at 103.53. And in the bond market, things get very interesting. Yields backing up by 30 basis points over the first 2 weeks of March, and all of a sudden, everyone seems to be saying buy bonds. This from JP Morgan's Mislav Matejka. We think that the move in bond markets might not sustain. If this conflict ultimately leads to a recession, it is, of course, unlikely central banks will be hiking. And if there is a respite, any inflation spike might be looked through. Buy bonds either way.
It will be a growth shock, given the fact that people are looking to potentially slowing growth, the idea of consumers that are pulling back because they don't have enough money beyond just simply to finance the higher oil prices. And this is a reason why people are saying, look, either way, people are overestimating the inflationary shock of oil, or people are overestimating how long growth can remain this solid.
422 on 10s this morning. At the front end of the curve, T's at 367. The Fed's two-day meeting begins a little bit later this morning. As we count you down to the open, about 3 hours away, let's get you some morning movers. Yahira has more. Hey, Yahira.
Hi, John. You are seeing a clear move into U.S. energy right now, with oil prices, as you said, triple digits right now after Iran struck a gas field in the UAE, as well as other targets in the Persian Gulf. And that is sending names like Sable Offshore and Occidental higher, as investors look for domestic names that are removed from the conflict but still benefits from the rise in crude prices. Meanwhile, one of the headline deals coming out of Nvidia's GTC conference is sending shares of Uber higher 2.75%. The two companies announcing plans to launch Nvidia-powered robo-taxis in 28 cities by 2028. Lyft also seeing a boost. Shares are up 1.3% after it also announced a partnership with Nvidia to use its AI for its machine learning systems. And we end on a big mover to the downside, and that is Linsar. This is an eye care company. Shares are plunging 23% after its takeover deal with Alcon, which of course makes contact lenses, fell apart. The two companies agreeing to terminate the merger following nearly a year of regulatory review and pushback by the FTC. John?
Yahira, appreciate the update. Thank you. Just reading through the fund manager survey just dropping from Bank of America just moments ago. This is the title: A cash surge, but no equity capitulation. Growth optimism tanking, cash levels surging. Here's some numbers for you. Global growth optimism has slumped to a net 7% from 39%. Inflation expectations have jumped to a net 45% from 9%. The epicenter of this, of course, is the Middle East on risk. Geopolitics and inflation replace an AI bubble as the biggest tail risk. And on asset allocation, Bramo, a March rotation from boom to stagflation.
Yeah, and a question of where do you put your money? Well, cash. We saw cash levels in this survey jump from 3.4% in February to 4.3% in March, which Michael Hartnett said was the biggest one-month jump going back to the pandemic. So trying to raise cash. Yet to your point earlier, not pricing in a recession, which really highlights that people aren't willing to throw their chips in and explains why we're seeing the action that we are in risk assets.
A big short in consumer discretionary stocks, the most underweight since December 2022. We'll keep coming back to those lines coming out of the Bank of America Global Fund Manager Survey published just moments ago. On our radar this morning, Morgan Stanley warning default rates for private credit loans could reach 8%. Analysts saying AI disruption within the software sector would push defaults to levels unseen since the pandemic. Elsewhere, Iran striking new targets across the Gulf, hitting key energy sites in neighboring countries. The UAE suspending operations at an oil field and export terminal following fresh missile attacks and drone attacks too. And finally, President Trump pushing to delay his planned meeting with China's Xi Jinping by a month, with the war in Iran remaining his priority.
I don't know. We're working on that right now. We're speaking to China. I'd love to, but because of the war, I want to be here. I have to be here, I feel. And so we've requested that we delay it a month or so, and I'm looking forward to being with them. We have a very good relationship.
China reportedly welcoming the delay, given the chances the war could lead to embarrassing moments during the summit. That, according to a person familiar with the matter.
Yeah, and also because they haven't really made a lot of headway going into this. They just had that 3-hour meeting between different negotiators from both China and the U.S. and didn't really come to any resolution. And typically, China likes to have something buttoned up to present at these summits. Also interesting, though, in terms of the signal from President Trump. Does this indicate the distraction from the war in Iran is making it difficult to tackle some of the other issues that he has out there? And I think that that's something that increasingly some of the foreign relations members are talking about and wondering what that does for the leverage dynamic.
Look, when you have tens of thousands of servicemen and women in the Middle East, and we have also had some casualties, there is no place the U.S. president needs to be than Washington, D.C. And the optics as well would have been bad. Of course, there's a number of issues. The fact that actually they haven't dived into these details. They are unprepared for this meeting. The Chinese actually wanted it at the end of April. So for them, they're thinking that this actually works well for them. But at the same time, this is a prudent decision from the president.
Reading between the lines, doesn't it also suggest they're prioritizing stable trade relations with China right now? Because of the optics, you could end up in a situation, an embarrassing moment, where the president is basically saying we need to reopen the strait. China depends on the oil coming out of the strait. Why aren't you doing enough? And ultimately, I think that's the tension they're trying to avoid.
Absolutely. Beijing does not want that attention. The president, every single day when he talks about the Strait of Hormuz, talks about the fact that the country that's the most reliant on it for their fossil fuels, or the country that gets all of the Iranian, the lion's share of the Iranian crude, is China. And that's going to be incredibly awkward for Beijing.
That's the latest on China this morning. Let's turn to tech. The Nvidia CEO, Jensen Huang, reassuring investors with a massive sales forecast of the company's biggest annual event.
Right here where I stand, I see through 2027 at least $1 trillion. $1 trillion is an enormous amount of infrastructure. That infrastructure investment you could make on Nvidia, you could make with complete confidence. We have now proven that.
Tony Wang, T. Rowe Price writing, strategically, Nvidia isn't just selling GPUs anymore. They're trying to be the platform agents are built on. Tony joins us now for more. Tony, let's pick up on that number, and welcome to the program, buddy. 1 trillion. What's he talking about? 1 trillion what?
Yeah, well, I mean, it's definitely a really big infrastructure number. But I think that what's really important is what underpins it. And I think we're seeing like Claude code, OpenClaw, and these are just autonomous agents that can continue to be operating 24/7. I think that's what's really exciting here, in that we don't have to have as much human intervention. And so to me, that was a big takeaway for me, that inferencing is really taking off here.
Tony, I just want to stay on the numbers. What are their revenue numbers right now? And what are you projecting for 27?
Well, look, I think that the numbers are big. They continue to grow. But I think it's the sustainability here that the market's looking at, is that what are the 3- and 5-year numbers going to look like from here? I think there's a lot of doubt right now that the market is assigning it. I mean, historically, semis are very cyclical. And so I don't think we've seen these kind of growth rates, these kind of numbers. And so, to me, the tech trends and the first principles of how the unit economics, the ROI on these tokens, that's what matters to me when I look out here.
Yeah, the $1 trillion number, just putting it into perspective, crunching some numbers, the total sales for Nvidia since 1999, total less than $600 billion. So this would be more than what they have done in all of that time. Does it exceed what you were expecting, though, going into this particular conference?
I think the number is really impressive. I mean, they're clearly upsized it from last year. And to me, it's a continuous, improvement in demand. And then when I look at like the roadmap, what's really important is that they are continuously dropping the token cost. And you saw that they are integrating with Grok, their new acquisition. And so these really impressive inferencing stats that are going down in terms of cost by 35 times. And so I think it's really like the demand meeting like their product roadmap, and becoming the inferencing platform that agents build on is really important, because there's all these new TAMs that are coming online, like robotics as well as agentic. So, the partnership with BYD, for example, and Uber, those are really important, statements in terms of people building on the ecosystem.
I'm glad you picked up on the cheaper aspect, and this goes to the whole CPU, the central processing unit effort that NVIDIA has worked on. Given the fact that Intel and AMD are trying to chart a territory into there to really eat some of NVIDIA's lunch, how much did NVIDIA fight back and actually impede some of the efforts that we've seen from some of the other chip makers?
Yeah, well, I think that it's becoming more of a system level solution. And so you have to bring the full rack and connect it to everything with the software. And so to me, I think the CPU is just one of the core areas of development. And it's becoming, a bottleneck. Every time you speed up one part, whether it's the GPU, then there's the networking, then there's the memory, and then there's also the CPU. And so I think that's why NVIDIA has been developing their own CPU because of that. And so to me, I think it's a whole system solution. Isn't just one piece that you need to focus on.
Tony, what struck me is one of these slides behind Jensen Huang, and he's talking about the $1 trillion through 2027, but at the same time, 60% of revenues come from hyperscalers. So hyperscalers need to do well for NVIDIA to do well. Is that a huge vulnerability right now?
Well, I think of hyperscalers as having internal workloads as well as external. So a lot of that is selling to Fortune 500 companies, new AI startups. And so to me, it's a pretty distributed customer set. And so what's important for them is are the token costs going down? Essentially, they rent these GPUs out, right? So if you have the best AI system and you saw the performance improvements are, anywhere from 3 to 10x, with the new systems, it makes sense because you can make more money renting them out. So to me, that's what really matters. And the hyperscale is an aggregator of demand in many ways.
Tony, before you go, can we just finish on the story of the moment, the story that's dominated the headlines for the last several weeks, and that's the Middle East. That was a source of revenue and growth for this company. And a lot of headlines came out of some meetings in that region over the last year. To what extent are developments upending the hope that that will be a big source of revenue in the years to come?
Look, I think that the Middle East is a big opportunity probably for U.S. tech companies and infrastructure. There's clearly a lot of demand there. It makes sense in terms of strategically what those countries are trying to do, and they have really efficient energy production. And so to me, it's an extension of the U.S. tech platform. It's important, for the ecosystem that, innovation is built on it. So to me, I think that what's going on in the Middle East right now is, hopefully, resolves itself pretty soon. And so I think longer term, the tech trends are usually what's most important to drive the companies.
Tony, good to see you. Thank you, sir. Tony Wang there of T. Rowe Price on Nvidia. Putting $1 trillion into perspective, some context here about how much money that company has actually generated through its history.
Which is the reason why your question's a good one. Is this bookings or is this sales through 2027, given the fact that the total volume of sales going back to 1999 was $567 billion. They're talking about $1 trillion in less than 2 years, exceeding by far anything that they have earned in the past several decades. It just highlights the pace of growth. Is this so much faster than people were expecting? Can they continue this pace? And what exactly are we talking about with this $1 trillion number? I think that a lot of people are going to be asking that.
Yeah, the stock investors faded that story pretty quickly yesterday after it spiked. The stock this morning positive by about 0.3% of the pre-market. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Yahara's back with more. Hey, Yahara.
Hi, John. The nationwide average of U.S. diesel is above $5 a gallon for the first time since December 2022. As the war across the Middle East continues to disrupt supply chains. And according to the U.S. Energy Information Administration, prices for residential heating oil have also climbed above $5 a gallon. Quite the chart there. Meanwhile, Chinese Vice Premier He Lifeng urging the U.S. to completely remove unilateral tariffs during trade talks with American negotiators in Paris. China's state news agency reporting He Lifeng warned that Beijing was ready to take steps to safeguard its interests. U.S. Trade Representative Jamieson Greer said the two sides are considering setting up a new mechanism to oversee economic ties. And the SEC reportedly preparing a proposal that would remove the quarterly earnings report requirement. Sources telling the Wall Street Journal companies will be given the option to report just twice a year and that the proposal could be published as soon as next month. The rule is expected to make quarterly reporting optional, not eliminate it altogether. That's your Bloomberg Brief, John.
Yahara, thank you. Appreciate it. You just wonder how much that would change. How many companies would still choose to publish quarterly?
We've already heard from a lot of them saying that they still would have to publish quarterly because it would be demanded by them of investors. Look, if investors were worried that there was some sort of malfeasance or some sort of surprise to the downside, well, they would start to sell the stocks because when in doubt, sell. I mean, haven't we learned? Isn't the story of this year transparency and the lack of it leading to people to just bail?
Getting some transparency from Delta right now. Some companies give you updates outside of quarterly earnings as well. Delta Airlines demand momentum. The first quarter revenue growth they see in the high single digits. They had seen 5 to 7%. That stock in the pre-market getting a nice little pop in early trading.
Yeah, expect a bunch of the airlines to restate their forward-looking expectations. They're at a conference, a JP Morgan conference in Washington, D.C. They're talking about how demand and capacity growth is still continuing to gain momentum. Look, big question, who is the best protected from this? Delta has a refinery, so they've been able to offset some of the impact. Whether we get the same story from some of the other airlines is another case.
Investors might be happy this morning. The stock is higher by more than 3%. I don't think travelers are right now. I'm not sure flyers are happy in this country at all.
Absolutely not. Jet fuel's going up, so flight costs are going up, and at the same time, DHS is still shut, so if you're someone like me that recently came back on an international trip, you cannot use global entry and all these other issues, and the lines are very long, and it's a headache.
Prices are going up, lines are getting longer. Up next on the program, two-sided risk from the Middle East.
The Fed will have to increasingly acknowledge the two-sided risk from this. It's not even clear that its response would be to be more hawkish, as is being priced in.
Blake Gwynn of RBC Capital Markets joins us next, live from New York City. You're watching Bloomberg TV. This is the kind of moment where corporate America and investors are looking for corporate America to provide some positive guidance. And you're getting that from Delta Airlines just moments ago. The stock is higher in the pre-market by 3.6%. They've raised their revenue forecast. They see some demand momentum. Here's the new number for you for the first quarter. Revenue growth in the high single digits. They had seen a range of 5 to 7%. The latest from Delta. Lisa, the stock higher by more than 3%.
Yeah, they didn't mention that capacity growth was impacted by winter storms. They also talk about other potential issues. That said, the fact that they're maintaining guidance and they're talking about momentum at a time when people are expecting some pretty dire forecasts from airlines speaks to at least this airline's resilience in the face of a lot of chaos. Whether you get the same tone from the others that are presenting at this JP Morgan conference will be something that we'll be watching throughout the morning.
Yeah, as we'd often say, is this a Delta story or a consumer story? It's often just a Delta story, and we'll find out when we hear from the others. Equity futures doing better off the lows. We're down by just 0.2% on the S&P. And as the two-day meeting gets set to begin down in Washington, D.C. over the Federal Reserve, your bond market looks like this. Bond yields on 2s and 10s slightly higher. The 10-year at 4.22. And the surveillance this morning, two-sided risk from the Middle East.
The Fed will have to increasingly acknowledge the two-sided risk from this. It's not even clear that its response would be to be more hawkish, as is being priced in. We really just don't see a huge amount of pass-through from this sort of headline inflation rise, which is really oil-focused, into core inflation. And so we look to the Fed to probably look through this.
So here's the latest this morning. The Federal Reserve kicking off its two-day meeting ahead of tomorrow's rate decision as the war in Iran threatens to pull policy goals in opposite directions. Joining us now to discuss is Blake Gwynn of RBC Capital Markets. Blake, good morning.
Morning.
I think we all remember the title of your note about 12 months ago. It could have been an email. Are you thinking that we get the same meeting later this week at the Federal Reserve?
Yeah, I think there's a lot of similarities. I think that was a meeting that came very soon after Liberation Day. Very much like Liberation Day, I think this energy price spike does represent a supply-related price shock that does pull the dual mandate in both directions. I think there's downside risk around labor, but then you also have to acknowledge that there's some upside price risk. So it makes it very difficult for the Fed, and very much like that May meeting last year, I think it's a little too soon for them to really come down on one side or the other. So they're not going to lean into the price side. They're not going to lean into what this might mean for demand, for growth, for labor. So I think we're just not going to learn a lot from Powell. I think that's our base case, is that he just plays it very close to the vest. We hear wait and see, we hear wait, careful, we hear a lot of words like that.
Unfortunately for them, because of their own communication apparatus, they have to put out some forecasts in the SEP. What's curious about this is that at the January meeting, the chairman was talking about a better growth outlook compared to the December meeting. Where are they going to be now when they sit around that table?
Well, it's interesting. I think what we're really looking for is a little bit of an upgrade to the inflation forecast, just given where core PCE has come in, since that last meeting. That makes it a little bit difficult because that is going to be a bit of a hawkish message if you see their inflation forecast going up. At the same time, we expect their dots not really to change all that much, for them to still show a cut. So I think that's one way they can kind of communicate almost a little bit of a dovish bias, because they're saying, yes, there are some, more upside inflation risks, or the outlook has increased slightly, but we're not really taking away the cut that we have in later this year.
There was a time when saying they, when referencing the Fed, made sense. Does it still make sense, given some of the dissent that you're seeing and some of the fissures on the committee?
That's a great call out, because I just used the word they, and you're totally right. I think it is hard to talk about them as a monolith. I mean, I do think there have been different camps, but I do think that this year that fissure has started to pull together a little bit. I don't think Waller's probably going to dissent at this meeting. I think some of the labor data that we've had, even though that February report was a little bit softer, we had the strong report in January. And I think even just the amount of time having passed, it does become somewhat clear that we're not seeing some kind of nonlinear deterioration. And I think that's really, if you go back to August of last year, they were really worried about this kind of stall speed concept. So I think the dovish side was worried this is just the start of, it's going to start, the unemployment rate's going to start ramping up. That clearly didn't really happen. So even though we got that poor report in November, it does look like it's kind of chopping sideways. So I think that dovish side is starting to collapse a little bit with the center.
So if it could be an email, would it just say things are balanced? We've got people on both sides, but we probably are going to stay where we are. And Jerome Powell's not going to talk about whether he's going to stay on after his term is up.
I think both sides, and we need to see how this stuff's going to play out. We just need to know more about how this war is going to play out, what the impacts of that are going to be, not just on the inflation side, but is there going to be demand destruction? Is this, is paying higher gas prices, potentially paying higher food prices, is that going to start to drag on consumers and businesses that are already a bit stretched? And they just don't know that yet.
Do you think Powell's going to get into what happens on May 15th if Kevin Warsh is not confirmed?
I don't think he's going to. He's been pretty evasive of those questions in the press conference. I mean, obviously, he released that statement that was that video statement where, that's probably the most we've heard from him on that front. But in the press conferences, he's usually pretty evasive on that. We did learn a little bit in the court documents that it does look like perhaps there's some plan to stay on. And if, we have this process frozen up because Tillis has said that he will not move that forward as long as those subpoenas still stand. It does look like they're challenging those in court. So maybe Powell just continues until these subpoenas go away, until they allow the confirmation of Warsh to go through. Maybe Powell's our chair for the time being.
I think you've just got to ask a direct question. Don't dress it up in the politics. Is this your penultimate meeting or not? At some point, he's got to answer that, and we're getting closer and closer to his final meeting.
Yeah, and increasingly, he's probably going to say, look, I'm here right now, and I'm not going to talk about that. But at this point, a lot of people are wanting to know, and how much is Tillis almost giving him a green light to stay on?
Also, take Powell out of it. Take the personnel out of it. What happens if a Fed chair is not confirmed and the current Fed chair's term is up? Take his name out of it. Take Kevin Warsh out of it. Just go through the process for us, Mr. Chairman.
Okay, I will. I'm not going to speculate because those things are out of my terrain.
They're not really,
right now,
though.
I'm focused on the economy and doing the job for the American people, which is to balance dual risks that potentially could hit the economy.
Isn't succession planning part of the job?
Yes.
It's not my succession planning.
Send us in. Me and Lisa want to go ask questions at this press conference.
I have a feeling that there's going to be a whole bunch of deflect and defer.
Like 20 seconds, go.
There was something interesting in the minutes, which is that they do approve the FOMC chair. So the FOMC votes on the chair. They approved Powell for a whole year in the minutes in January. So presumably, if nobody's there to replace him, he serves the rest of the year.
Blake, it's good to see you. Thank you, sir. I'm not sure what the president will think about that, but stay tuned. Blake Gwynn there of RBC Capital Markets. Up next on the programme, Alex Altman of Barclays, Bob McNally of Rapidan Energy, Jonathan Pingle of UBS from New York City, the second hour of Bloomberg Surveillance. Up next.
When it comes to Iran, we really just don't see this having a big impact on Fed policy at this point.
They do not want to hike in a period where growth dynamics were deteriorating.
The challenge is going to be this push and pull between potential for lower growth and potential for higher inflation.
No central bank is going to be hiking into this.
If this gets worse than people anticipate, we should be talking about more cuts, not less cuts.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and the price action scores look like this. Equity futures on the S&P pulling back by just 0.1% on the S&P 500, following a bounce yesterday, which followed a 4-day slide. If you see that move, you can guess this mood. Crude, WTI and Brent advancing slightly this morning. 103 on Brent, 96 on WTI, up by close to 3%.
And you have right now Iran attacking infrastructure at gas fields in Qatar, in the United Arab Emirates, other oil fields in Iraq. And it raises a question of how long this is going to go on. And are we breaching the amount of time where suddenly people have to price in a higher risk of long-term disruption? We're looking forward curves in the oil market. They're creeping higher. So at what point does this start hitting growth estimates? And at what point does this start more materially affecting your risk appetite?
Yeah, waking up this morning to further headlines of strikes on energy infrastructure across the Middle East, and a notable headline crossed on a Bloomberg terminal just a few hours ago. The Israelis indicating that they've eliminated the security chief in Iran. That's a major headline as they pursue their goals in this war.
Absolutely. Ali Larijani is an individual that is really part of this security complex, also an individual that the United States sanctioned in January because of the horrific crackdown of the Iranian protesters. I've been speaking to Norman Rule offline, former head of intelligence on the Iranian desk. He says it reshuffles the deck. Obviously, this needs to be confirmed by the U.S. Denies the leadership cohesion. What to watch for will be signs of regime entropy. So really also, when the president speaks about this, I think he's going to reiterate what he said yesterday, which was not really sure who we're dealing with right now in Tehran.
And that could be a problem or a solution. We don't know. That's how confusing things are at the moment. For the Federal Reserve, equally as confusing as they look at their mandate of inflation, price stability and full employment. The Federal Reserve getting together a little bit later this morning. That two-day meeting commences. That decision is on Wednesday. A whole host of central bank decisions through the week. On Thursday, the BOE, the ECB and the BOJ.
I'm actually more interested in the ECB and the Bank of England than the Federal Reserve. And I don't think I've said that very often, if ever, because usually it's watching paint dry with a lot of rhetoric that doesn't really move the needle. But over with the ECB and Bank of England, there are now price hikes, rate hikes being priced into the forward curve, which really puts them in a hot seat, given that you also have a much more significant hit to growth in that region. How do they navigate that? How do they navigate fragmentation in the region? In the United States, they can remain on hold and mumble jumble about dual mandate and go home. It's a little bit different over in Europe.
My bar for the ECB is somewhere down there. I can't quite see it. It's very, very low for a news conference of the ECB. I'll say this about central banks. When they have big moments like this, they're actually very, very slow to react. And then when it's very, very obvious, they go all in, and as fast as they can. And I would remember the pandemic. We all remember that famous line that came from Christine Lagarde, the ECB president, "We're not here to close spreads." What do they do a week later?
Close spreads.
They close spreads pretty quickly.
So this is why I'm actually curious to see whether they see this more as an inflationary shock or whether they do address the growth shock aspect and speak to a disinflationary future beyond what we're seeing right now. Because right now in the U.S., people are starting to come around to that view more than some sort of prolonged inflationary shock.
Need to talk about some single names as well. Delta Airlines in the pre-market up nicely by more than 3%. An update from the company moments ago. It is a raise to the outlook, a lift to the outlook, and I think that's key at a difficult time.
Yeah, they say that they now expect high single-digit revenue growth for the first quarter. That's up from 5 to 7% at a time when they are crimped by both TSA lines, by both international travel being potentially disrupted by the Middle East, and by oil prices that are about a third of the total cost. Of course, they have exposure to refineries, which can offset that. And they do say they maintain the ability to adjust capacity to meet some of the higher oil prices. Does this mean they're going to take some planes offline and really consolidate everybody in the same tube as much as possible?
We're seeing that across the industry at the moment, aren't we? And they're certainly leading, that's for sure. Some updates from the airlines throughout this morning. Equity futures on the S&P. Net session highs down just 0.1%. Coming up this hour, we'll catch up with Alex Altman of Barclays as the equity rally stores. Bob McNally of Rapidan Energy as Iran squeezes energy flows through Hormuz. And Jonathan Pingle joins us of UBS as the Fed feels the pressure of the war. We begin this hour with our top story. Iran intensifying attacks on critical energy sites across the Middle East and taking a hit of their own. Bloomberg's Jabana Basechi joined us from Dubai for the latest. Good morning, Jabana. Let's get the latest on that strike, not of the Iranians, but of the Israelis and the update that came from them a few hours ago.
Yeah, so lots of developments to get through, John. I would say the main one that has occurred in the last hour or so was the Israeli defense minister announcing that they had successfully killed Ali Larijani, that is the chief of the National Supreme Council. a very authoritative figure, very close to Mujtaba Khamenei and his father, part of that inner circle. He was a former commander of the IRGC, and he was seen patrolling the streets of Tehran on Friday at this pro-government demonstration. He's been very active on Twitter, on X, I should say, throughout the course of this war. So a significant assassination, if indeed it is confirmed by Iran. We're waiting for confirmation. And the Israeli defense minister also saying that they, through another operation, also eliminated the key figure behind the Basij. This is a paramilitary force also responsible for some of those very brutal crackdowns against the demonstrators that we've seen over the past few years. And of course, the most recent incident being back in January. So this would be two very prominent assassinations. What I would say, though, is that in the past hour or so, people have said that this could have been one avenue for a diplomatic off-ramp, and namely because Ali Larijani was involved in some of those nuclear discussions prior to the war started. The question from here onwards is who is going to be responsible for a potential off-ramp if indeed the diplomatic channel is reignited. For the time being, though, I will say Iran continues to lash out, especially at its Gulf neighbors. Here in the UAE, another challenging night. Residents here, we received multiple missile alerts on our phones throughout the course of the night. Airspace was closed for a couple of hours. And then, of course, we found out in the morning that they had targeted more energy infrastructure sites, including that Shah gas field, which is in a remote part of the UAE, but accounts for about 20% of the UAE's gas production, about 5% of the global supply of sulfur. More strikes, attempted strikes at the Fujairah, that key strategic port that we spoke about in the Gulf of Oman, not even on the Strait. And then more attempted strikes on those eastern fields in Saudi Arabia and in Iraq as well. So they have branched out in terms of the targets. The interception rate, I should say, is still very, very high. But the point is that Iran clearly, over the last couple of days, has stepped it up with their efforts to target key logistics, infrastructure, and energy sites across the Gulf.
I can't imagine how tense things are in your region, so thank you for making time for us this morning. Jumana Basechi there, leading our coverage of this war out of Dubai. Yesterday, Brent crude down by almost 3%, still closed above 100 for a third consecutive session. Tracking the traffic through the Strait of Hormuz, just a handful of tankers getting through. Very, very dependent on the flag that's on that vessel.
Absolutely. So you saw a Pakistani tanker get through. Obviously, Chinese and Iranian ships are getting through. Some Indian vessels have been able to get through. What this shows is that the Strait is actually not closed. It's controlled by the regime. And if you are having conversations with the regime, you're able to get your cargo through.
Brent crude 103 so far this morning. Here's the view on Wall Street. Alex Altman of Barclays writing this. Investors should be mindful of the one-sided debate around Iran. Systematically betting against President Trump has generally been a high-risk, low-reward strategy. Alex joins us now for more. Alex, good morning. Good to see you.
Good morning. Good to see you.
Is that true of this incident as well?
I think that it's important to take a balanced view. And that was the point of that message and that email, was that if you go out and talk to the investment community right now, it's such a lopsided debate. You would almost think it was borderline Iranian propaganda. And the narrative is there's no way the administration can get out of this hole. We've painted ourselves into the corner here, and along those lines. And I just think that we need to take a more balanced view, is that the president has shown in the past multiple times his ability to wrong foot markets, to wrong foot whatever the consensus narrative is, obviously most recently with Liberation Day. And especially when positioning has actually moved quite aggressively, neutralized now in US risk especially, we should just be prepared for a slightly more balanced debate.
The pushback to that is when you talk to oil strategists, they're not talking about President Trump. They're talking about just the actual barrels that are available and not transporting, and just how big the deficit is becoming. How do you brush off the fear that you're seeing in the physical crude market, which is pricing in a much higher price than what we're seeing in futures, as well as some of the commentary coming from some of the CEOs of big oil companies?
Well, look, I mean, I think you've got to take into account the fact that, look, the physical market, I'm not going to be able to sort of be an expert on. I'll defer to other individuals on that. But what I will say is, remember, there's been a lot of experts that were pricing in or saying that oil was going to go to $40 a barrel. And then those same experts were saying that potentially the Strait of Hormuz wouldn't close. And now all of a sudden, that you've got a lot of individuals that are talking about every $10 a barrel, every $1 million a barrel that's taken off is equivalent to $10 increase in price. And yet, actually, it's been about half that number so far. Now, why is that? So I think we just need, again, I'm just trying to basically bring back a little bit more balance to the debate.
I know where you're going. You're trying to identify some asymmetric opportunity. I hear that. But the problem is this is not April 4th. On April 4th, we dropped 5%, then almost 6% on the S&P 500. We're only 4-5% away from all-time highs on the S&P. Has that dislocation actually opened up yet?
I would say that parts of the market have. So you've got to remember, the market was pretty well hedged going into this from the fast money community. And that's not universally true. Look at, like, for example, CTAs, they were pretty long rest of world equities. And again, if we just look at the S&P, then I think it's only one dynamic. We look at Korean equities. Look what happened in Europe. Europe was outperforming US equities by 7% going into this. It's now effectively wiped that out. So it's significant underperformance from any region that was a net energy importer. So we have to sort of look a little bit more holistically. But you're right, there is still a body of equity risk in the US that if they sold, it would be a serious problem. Number one, obviously retail. We're in that tax window right now where retail are notoriously going to buy less equities because they've got bills to pay next month. And then also vol control. Vol control exposures to US equity risk is still, I'd say, in line with the long-term average. So there's room for them to go materially lower. But that will require a significant vol shock beyond here. And so that's something that you've got to consider. What could drive that from there?
You have seen a significant vol shock when it comes to certain emerging markets, when it comes to the rest of the world. And this is sort of turning everything on its head from the first couple of months of the year when everyone was saying, sell America, go diversify to the outside. Is this a tipping point where people come back to the U.S., or are you going to move counter to that? Do you think that all of this is overblown in terms of the hit to growth globally?
I think, I think trying to forecast the path of this Middle East conflict is incredibly difficult. It's fraught with difficulty. But what I will say is that it once again highlights U.S. exceptionalism in different formats. So remember, all those dollar flows that were going to rest of world, they're all net energy importers, whether it's Europe, Korea, Japan, these were the three biggest regions. The US, big net energy exporters. So it's yet another reason, on top of the fact that we've had a significant domestic derating of the equity market, on top of the fact we've still got corporate exceptionalism that hasn't gone away, on top of the fact we're dealing with a capex cycle for hyperscalers, some of the best companies in the world. And I think a lot of people kind of lost sight of that in favor of foreign equities. And I think that, yes, I think this does bring back home another reason why actually the domestic equity market may be slightly safer in a port of storm, than other parts of the world.
Alex, you're very constructive on the president and his ability potentially to see the thresholds and the pain thresholds in the market and act. And he did that in Liberation Day. But what happens when you have a massive question mark on the other side? The president said yesterday it takes two to tango. We're talking about a regime that are not rational actors. And right now, they're going to have to come out and at least show a bit of sign of force because we are absolutely decimating their top brass.
And so I think that the key point that I think about, again, first of all, balance is trying to think about the two-way debate and not to in any way go against what you're saying. I think that those risks are real. I would just highlight that the key word is regime. And if the regime wants to survive, then it is at some point going to have to negotiate. And I think that's what a lot of people at the present have lost sight of. Because if you do start going down the threats of destroying civilian infrastructure, that effectively is the regime gone. So I'm working off the basic premise that if that regime doesn't in any way, shape or form want to exist a year, 2 years, 5 years from now, then they will actually have to at some point step up to a negotiation.
But what if the damage is done? Lisa was talking about physical barrels. If you look at where Omani crude is and Dubai crude is right now, they are closing at $55 premiums to Brent. Those are physical assets and cargo. You see diesel today, $5 a gallon. That's freight. That's our food, how we get our food to our table. At some point, how long can this last where you start to think potentially this is going to have a bigger impact?
Look, again, I think that trying to determine the path of war is incredibly difficult. Diesel, $5, you make a great point there. It reinforces actually the lack of sensitivity from a US-specific perspective. As a case in point, every 10% increase in diesel prices domestically only affects the food basket by around about 50 basis points in terms of the price increase. And even that, based upon some analysis, will probably take about 12 to 15 months to feed through. So from a domestic economy perspective, we're, I would say, a little bit more insulated from this. And of course, if it goes on for a long period of time, yes, then of course all bets are off and we would probably expect a significantly lower move in risk assets. But I would just sort of highlight one final point, which is the sensitivity of risk assets to these moves in oil prices are also decreasing.
It's true.
Right? So, and I think we've got to, it's as much about the velocity of the move in oil as it is about the level. And I think this is an important point here. Between 2011 and 2014, the US economy averaged $95 WTI, averaged. And during that time, stock market went up and the US economy was okay, right? So the velocity of the move, I think, is what really surprised people. So if that velocity begins to decelerate and this is our new baseline, more or less, then I actually think it's something that we can become desensitized to.
A constructive view from Alex Altman of Barclays this morning. He's sticking with us. The equity market's doing okay. It's down by not even 0.2% with an update on stories worldwide this morning. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump continuing to ask other nations to help secure the Strait of Hormuz. The president voicing frustration with countries that have been publicly non-committal about helping ensure vessels can safely pass through the key waterway. He has called out NATO and others for failing to act. Meanwhile, we are seeing shares of Delta rising more than 4% in the pre-market. The company issuing a more optimistic sales target for the first quarter after bookings accelerated into March. The outlook showing the carrier's resilience in the face of higher jet fuel costs. And Bank of America releasing its monthly fund manager survey for March, finding sentiment has begun to turn bearish after months of near-peak optimism. The war in Iran and concerns around froth and private credit have begun to weigh on investors, overtaking AI bubble concerns as the biggest tail risks. Rate cut hopes now sitting at their lowest levels since early 2023. But so far, no one is pricing in a recession. That's your Bloomberg brief, John.
Yeah, just to pick up on that last line, I think it's so important. Yahara, thank you. Lisa mentioned this earlier on the macro. Global growth optimism has slumped to a net 7% from 39%. On inflation, expectations have jumped to net 45% from 9%. Rate cut optimism is the lowest since February 2023. But, and this is the key but, no one is pricing in recession. The probability of a hard landing is just 5%.
This is not full bear. This is people who want to be bearish, sort of, because they know it's the prudent thing to do, but are still fundamentally bullish, which is the reason why they're hoarding cash. Is it because they're scared, or is it because they want to buy when the all clear is sounded? And ultimately, a lot of people are preparing for the latter.
Lining up to buy. We'll talk about that in a moment. Up next on the program, sidelining the China summit.
We're speaking to China. I'd love to, but because of the war, I want to be here. So we've requested that we delay it a month or so, and I'm looking forward to being with them. We have a very good relationship.
Up next, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Equity futures down by not even 0.2% on the S&P 500. Just a little bit of weight to the tape, as TK would say. On the Russell, the small caps are down by 0.4. In the commodity market, Brent and WTI, Brent crude higher by about 3% this morning. 103 on Brent, WTI at 96. Under surveillance this morning, sidelining the China summit.
I don't know. We're working on that right now. We're speaking to China. I'd love to, but because of the war, I want to be here. I have to be here, I feel. And so we've requested that we delay it a month or so, and I'm looking forward to being with them. We have a very good relationship.
So here's the latest this morning. The president looking to delay his meeting in Beijing with China's Xi Jinping as the Iran war upends his foreign policy agenda. With the latest in Washington, Tyler Kendall has more. Hey, Tyler.
Hey, John, good morning. Well, as you heard, President Trump is requesting to delay this meeting by a month or so, in his words, as a person familiar with the matter tells Bloomberg News that China is willing to grant the request for a delay, given in part that there was considered to be a short preparation period ahead of this visit and amid, of course, uncertainties with the war. Now, we heard President Trump saying that this decision came solely because he is needed here in Washington to oversee military operations, despite previously signaling that he could request a delay if China does not send assets to help secure the Strait of Hormuz. In fact, China has been at the focus of a lot of the president's pressure when it comes to the strait.
Tyler, that's a good time to throw back. Tyler Kendall there with the latest from the White House. Just can't get a break outside the White House, can you?
Her timing nailed it, though. Yeah, but they're always this time, 5 to 8, 9 a.m. The workers are always out there making sure it looks pristine, so it's always a challenge.
Leaf blowers start to come out as well. Yeah, I get it.
That'll be next.
Alex Altman of Barclays, still with us around the table. Alex, this from Jonathan Krinsky of BTIG. You're sounding constructive. This is the bad view, OK? Perhaps the real pain trade would be if we get a deal and we get a rally off the back of the deal, but that gets sold. The weakness we're seeing started well before the geopolitical escalation, so why would resolution there fix all the damage that's being done?
Well, I know Jonathan, and he's right in the sense that I think if I was to sort of parlay his words into what else should we be talking about? We should be talking about private credit. We should be talking about AI disruption. Remember those nice narratives we were talking about before the Iranian war kicked off? And yeah, those aren't going away. However, I would say they're much more focused topics than necessarily as a catch-all that is as big and as problematic as the Iranian war.
That said, Morgan Stanley came out with a report saying that you could see an 8% default rate among private loans if you do see this software disruption really take hold because of the structure of some of these loans. Is the market being overly complacent in the face of some of those risks just because they're distracted with what's going on in the Middle East?
Well, look, from the conversations we have, I would actually say that private credit is something that investors really want to talk about. That's what they wanted, the topic that's really at the center of the debate. Are they complacent? I would say no. I mean, look at some of the alternative asset managers. I mean, these names have been cut in half, essentially. They're down between 35 and 50%. So, no. Has it spread to the broader market? Well, to a degree, yes. Obviously, high yield spreads have moved out 350, 375 on whatnot. Is that showing you complete panic? No. I mean, you could easily see them 100 basis points wider than that. I mean, ultimately, high yield is a 300 basis point to 700 basis point kind of spread range asset, and we're still towards the tights of that. So there is a degree of complacency. I would say that the counterpoint to that is that trying to understand what innings we're in on a private credit unraveling is incredibly difficult. What I would add on top of that is that not all private credit is bad, and not all bad credit is private. And I think there's a lot of ultimately private credit, public credit, they're all credits at the end of the day. And I don't think you should necessarily disaggregate them from one another. And ultimately, are we going to have a credit cycle at some point in the future? Yes, we probably will. That's just inevitability of the way the world works. But does that necessarily mean that it's all doom and gloom? And again, I just want to take a more balanced view. And the reason I want to take a balanced view is simply because the world or the US economy is sitting on the lowest private debt to GDP in the past 25 years. The banks are the best capitalized they've been in a very long time, having been under regulatory thumb basically ever since the GFC. Yeah. We've got $7-8 trillion of money market funds. We are in, as an economy, a better place to handle a credit cycle than we were at any point for the past 2 decades. And that's
to the conclusion, Alex. Trade for the brave. Are you saying there's a buying opportunity here?
I still think there is a buying opportunity in risk right now. Yes.
In the banks and in the private credit players.
So if push came to shove, do I think that, again, I'm not going to get into individual names, but do I think if push comes to shove in certain of these alternative asset managers that they will still exist? Will they still be generating fee-related income a year, 2 year, 5 years from now? And I think the answer is yes. Do I think you could see a multi-percentage point impairment to their assets? Yes, but ultimately they've derated spectacularly. And just a point, sort of a line that you guys can work with is that if you go back since 1990, financials have only ever sold off as a group 50% more than 50% once, and that was in the GFC. Right now, those alts are down basically 50%.
We'll run with that line this morning. It's good to see you, buddy.
Good to see you.
Thank you for dropping by. Alex Altman there of Barclays. Up next, Bob McNally of Rapidan Energy as Brent holds above $100 a barrel from New York City. You're watching Bloomberg TV. Stocks just a little bit softer. We're down 0.1% on the S&P, and the Nasdaq down by 0.2, down by 0.3 on smalls. This from Mike Wilson and Morgan Stanley to start the week. Constructive. Why is our constructive 6 to 12-month view still intact? The answer, the main reason, is that the earnings acceleration is continuing and that the current setup looks very different from the prior late cycle periods when oil spike ended the business cycle. That's the latest from Morgan Stanley this morning. Here's the crude spike. A rally continues this morning. Brent and WTI. Brent crude up by 3% at 103. WTI up by 3% also at 96. Unlocking this in the bond market. Slightly higher yields through this morning. Now lower, turning lower by almost a basis point, 421. But the move we've seen over the past few weeks, 30 basis points plus at the front and long end of the curve on 2s and 10s. What does it mean for the Federal Reserve? This from Neil Dutter over at Renmac. It's much easier to see the Fed revising up core inflation than changing the unemployment rate outlook materially. And here's the punchline. I think it is more likely that a cut is erased altogether in the outlook.
Right now, we're seeing markets flirt with that idea. If you get that kind of hawkish pushback to markets that are still optimistic about one rate cut, do you have some really fierce rhetoric on the other side? Again, this committee is split. This is not going to be one decision that's coming out. You're going to hear a couple of different points of view. So again, how much guidance can they give at a time when events are fast moving, when the economy is unclear, and when the personnel at the top of the Fed are going to be shifting around?
Fed decision tomorrow. Are they going to be shifting around? We'll find out. We'll try and get some clarity from Chairman Powell. Chair Powell forever at this point, right? He's got to answer some questions about that. I'm sorry.
Well, you know, maybe we'll find out on Apprentice.
Penultimate meeting or not? When do you leave? Haven't you got some plans to make?
I'm guessing we're probably not going to find out, but I'm hoping that people press him on that because, frankly, a lot of people are trying to figure out that answer.
Neil Dutter of Renmac, who I mentioned a bit earlier, is going to join us tomorrow in anticipation of that news conference and decision tomorrow afternoon. 2 hours away from the opening bell, let's get you some morning movers. Danny has more. Hey, Danny.
Hey, John. Some airline earnings this morning. Delta out with a better forecast for the first quarter, seeing revenue up 7 to 9%. That was previously the 7% was the high range of its previous end. There's still demand, and they're able to weather some of the literal weather issues for them. They've seen less capacity because of the winter weather. JetBlue, same sort of story, better demand, but they are seeing higher costs, as are all these airlines because of higher fuel prices. Delta, for example, has been down 7% since the start of the war. That rebounds more than 5% this morning. Speaking of the war, just some of the stocks moving as we tend to see as the intensity of the war picks up. The fertilizer companies, CF Industry, Mosaic, are on the up this morning, 1.4%, 1%. The underlying fertilizer chemicals themselves, urea, has seen a sharp price spike higher because about half of that product flows through the Strait of Hormuz. Now, relatedly, we've also seen an increase in attacks on oil infrastructure, including a suspension of operations at a UAE natural gas facility. So some of the energy providers, which we should have in a moment, but if not, they are moving higher. Occidental being one of them. Interestingly, that UAE field is a JV with them. But all of these American ones moving higher. Devon Energy, Sable, Occidental, all up at least 1 1/3%, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. Incidentally, Neil Dutter of Renmac just wrote in on the outlook over the Federal Reserve. So he's saying there'll be no cuts in the SEP when we get the projections from the Fed. No cuts implied in those forecasts for 2026. He said the RBA just hiked. They all think the same way. Central bankers.
Well, this to me is a real question for the ECB. Are they going to make the same mistake? The Fed has more leeway to make that mistake because no cuts is different than hiking rates. That is a very different expectation. There's a feeling you need to fight the inflationary shock. Long term, it always is. Potentially a hit to growth. The bond market's starting to price that in. Does the central bank rhetoric start to match with it?
Huge week for central banks coming up. Federal Reserve, of course, tomorrow. Then on Thursday, BOJ, ECB, BOE. On our radar this morning, Iran stepping up attacks on energy infrastructure around the Persian Gulf, setting a massive gas field on fire in the UAE. The overnight strikes also targeting an Iraqi oil field and key Emirati port. Elsewhere, the president reiterating his call for other countries to help secure the Strait of Hormuz.
We strongly encourage other nations whose economies depend on the Strait far more than ours. You know, we get less than 1% of our oil from the Strait, and some countries get much more. So we want them to come and help us with the Strait.
US allies in Europe and Asia hesitant to send ships to Hormuz, expressing unease about getting pulled into the war. And the president claiming he can do anything he wants with Cuba as a US-imposed oil blockade causes a total power blackout on the island.
You know, all my life I've been hearing about the United States and Cuba. When will the United States do it? I do believe I'll be having the honor of taking Cuba. That'd be good. That's a big honor.
Taking Cuba.
Taking Cuba in some form, yeah.
Trump previously saying he will finish the war with Iran before turning his attention to Cuba. The word in there, very interesting, taking Cuba.
It's almost like, and I think what started that conversation was Peter Doocy asked, is this going to be like Iran when it comes to Cuba, or is it going to be like Venezuela? And he said, I can't tell you that, but they're a failed nation. But already the administration is making it incredibly difficult for the communist regime in Cuba. They've cut off fuel imports coming from Venezuela, which for months, which is why they have continuous blackouts. A key report yesterday from the New York Times. As we see these negotiations take place, the Trump administration is basically saying the president cannot exist in Cuba. They have signaled to Cuba negotiators that the president must go, but are leaving the next step to the Cubans. So it feels like the Venezuela situation, but potentially leaving it a little bit more in the Cuban hands.
You can forgive traders for feeling a bit numb, because ultimately it's Venezuela, then it's Iran, now it's Cuba, and ultimately people are focused on private credit and other things, because how do you analyze or get an edge on this? And ultimately, I don't think I have an answer for that.
I'm not sure anyone has an answer to that at this point, which is why a lot of people chose to ignore it.
And I think at this point, people are turning uncomfortably numb with all of the potential headlines.
What do we always say, that Rick Reader line? You can only focus on the shark closest to the boat. There's tons of sharks off in the waters at the moment.
And none of them are predictable, and none of them are really visible. I mean, ultimately, you don't know the scope of how big that shark is. So you're focused on the private credit shark, which is right here and analyzable.
Let's get to another shark. Closest to the boat right now, Brent crude, holding it over $100 a barrel this morning as doubts linger over a US-led coalition to protect energy flows through the Strait of Hormuz. Bob McNally of Rapidan Energy predicting disruptions will last a few more weeks, writing this. It appears that our 30-day worst-case Hormuz disruption scenario modelled last June may have been overly optimistic. Bob joins us now for more. Bob, welcome to the programme. Speaking of optimism, there were a number of tankers that got through the Strait yesterday. I think that provided some people in this market some comfort. Could you give us some perspective on that?
Hi, John. I think you're right. You know, we also saw traders were probably hedging the beginning of the SPR draw in the United States. The president called for escorts and so forth. And as you noted, the Iranians are letting out a few hostages. And so Secretary Besson also made comments saying this is a good thing, you know, we're supporting it. So, you know, the market, John, in my view, is still coming to terms with the fact that a load-bearing assumption in energy is collapsing. And that load-bearing assumption is that the U.S. would permit anybody to strangle the Hormuz Strait for more than a few hours to days max. And so I think there's still this reservoir of kind of disbelief and hope that this is going to be over soon, that this math, these disruptions, not only for oil, other things, as you just noted, Danny noted, it's got to stop. And so we took a breather yesterday, but it's not stopping, and crude is going to march higher, I'm afraid.
Bob, is it a good thing, though? I know you reiterated the words of the Treasury Secretary. Basically, the regime is saying this international waterway is not closed, it's controlled, and it's controlled by us.
Right, Annmarie, but they're not going to let enough oil out to put oil prices down. What should have been obvious is Iran would play the only card it had, which was to inflict an oil price increase and a gas price increase on the president. It's the only thing it has left. Its military's gone even since last June. So Iran's going to let out a few tankers just to divide the United States from other countries and curry favor, just enough, but it is not going to allow enough out to halt the upward march in crude and product prices, in my view.
Is there a point where the prices are too high, where some of Iran's backers, like China, start to put pressure on the regime?
You know, I think so. I think as we get closer to that level, which we may discover, which is where global economic growth starts to slow, because you can't have global economic growth without 20% of the energy returning. Whether that level is 150, 160, we don't know. But yes, when we start seeing shortages too, when refiners have to start dropping runs, which we're starting to see, when folks run out of refined products in Asia, jet fuel, that's when things get serious, and China will increase pressure. We expect so will other countries.
What's your forecast for full year oil prices, given the fact that when you look at the forward curve, you're looking at something like $75 a barrel by the end of this year? Does it seem like that is an underestimation or an overestimation?
Well, one thing I've learned is the futures curve is an awful predictor of future spots. So we ignore it entirely for that. Lisa, it's really tough. I'll say my oil analyst colleagues at Rapidan Energy Group, we're putting together balances. We're updating them here, but we could be at 30 by the end of the year. If we have to go to 150 or 160, but booms tend to be followed by busts. So 70 is as good as any other price at the end of the year. It's wildly uncertain. As you guys noted, with all the sharks circling, almost any price is imaginable toward the end of the year. And the higher we go, though, I'll say, the lower we're likely to be at the end of the year.
Can you walk us through what goes into that? Is it demand destruction, or is it people looking for alternative uses of energy? I'm struck by Jeff Curry. He put out another note this morning. You can't print molecules, talking about all the stockpiling that's going to take place after this and how we really never even recovered from the Houthis and what happened in the Red Sea. It took a while. Why do you think that isn't likely and prices could inflect so much lower?
Well, it's about demand destruction. So what happens is, if you look at all the major recessions in the since World War II, an oil price spike is usually present at the scene of the crime. They either caused it or contributed to it. Because oil demand, if you think about it, is really inelastic. It's not like going to the movies or buying cigars or whatever people do. It is necessary for life, right? If the pump price is higher, you still have to drive to work. So the only way to get demand down is to stop the work, if you will, is to slow economic activity, because oil is embedded in that. So what happens is oil keeps on rising until it causes a demand slowdown. And then when that happens, demand collapses. It goes away and the price collapses. We saw that in 2008. We saw that in other times. And I'm afraid that's what we could be looking at here if we have to balance this market by demand destruction at much higher levels.
Bob, I'm really glad you brought up products. Goldman Sachs was out with a note saying that the greater impact will be on products like jet fuel, like on diesel. We saw diesel hit $5 a gallon, north of $5 a gallon. That is important for freight. That's important for construction, for the factories in America. We haven't seen that since the spike of December 2022. You worked in the White House. What policy tools do you think this administration is ready to deploy?
Well, we've seen the policy tools more or less deployed already. They're looking at a Jones Act waiver, which helps because now the East Coast of the United States can bring in a little more product from the Gulf Coast at lower price. That was a good step. There are a few other things. They can ease RVP or kind of volatility waivers, regulations on gasoline to make it a little easier to make gasoline this summer a little more cheaply. So there are nips and tucks they can do around the edges, but they're really marginal, Annmarie. I think there's really nothing they can do. The only major things now, I think, on the table would be big mistakes. The idea of intervening in futures or restricting exports. I don't think export restrictions are on the table, but in a panic, you can't rule that out. Futures intervention, I know, has been an issue you have been covering. Right now, it's about avoiding mistakes, I think, not coming up with policy solutions to these especially refined product problems.
Bob, I've got to ask you, because you mentioned it, what would that look like, restricting exports? Because as a professional like yourself, it's obviously something you don't think would work, but don't rule it out for a politician who is probably looking at other things. Bob, what would that look like?
Yeah, stroke of the pen, John. I mean, President has clear authority there under emergency economic powers. He could just stroke of the pen, say we're not going to export gasoline and diesel anymore. We're not going to export crude. He can say we're going to wait until stocks get to a certain level, or if they get below a level, we'll restrict exports. He can do pretty much whatever he wants with regard to restricting exports. So the power is clear. It would take 2 minutes, stroke of the pen. It would be an amazing, massive mistake, but you can't rule it out. Again, I hear, listen, I don't think they're looking at it. I don't. I think they know it's dumb. I mean, they got elected partly by criticizing President Biden for restricting kind of gas, LNG exports. So it's a last ditch.
Given the Biden administration, look, the lesson that I've always had from following politicians, Bob, never underestimate their ability to do stupid things. Bob, it's good to see you. Bob McNally there of Rapidan Energy. This from Delta. So this is important. We're talking about the energy outlook. Let's talk about the reality on the ground. How are consumers interacting with the economy? Is that changing? Ed Bastian of Delta Airlines, the CEO, speaking at a JP Morgan conference just moments ago after raising their outlook for the first quarter, saying this: we've seen 8 out of the 10 highest sales days in history. in the month of March.
Yeah, talking about how it really has been both the main cabin as well as premium leisure. Talking about the hedge on its fuel that it has from the Monroe refinery, but without that. And I think that this really highlights the pain aspect of this well, that they're able to overcome with demand. They saw a $400 million spike in fuel costs in March. Even with that, they still see profits on the higher end and above what they had previously said because of that demand that you were just talking about.
Stock is up by 4% in the pre-market. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Brent continuing to trade above $100 a barrel as Iran strikes new targets across the Persian Gulf. The UAE suspending operations at the Shah natural gas field due to a fire, while a drone attack temporarily shut the Fujairah port. Meanwhile, an Iraqi oil field and a key Emirati port were also targeted. Australia's central bank raising its key interest rate for a second straight meeting, stepping up its battle against inflation as rising energy costs from the Iran war threaten to intensify price pressures. The Reserve Bank's 9-member policy committee splits 5-4 in favor of a hike. The decision reverses 2 of the 3 cuts delivered last year. And Kraft Heinz is rolling out a range of healthier products to bolster some of its lagging brands. The company planning to unveil a high-protein Kraft mac and cheese, a snack-sized version of Lunchables, and a low-sugar hydration beverage from Capri Sun. Kraft is investing $1 million to offer shoppers samples of some of its new products. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Why are you laughing?
I just think it's really funny, the things that people will buy in order to not feel as guilty to give their children.
High protein mac and cheese.
It's really good for you because it's got extra protein in it.
You're not convinced?
I mean, it just speaks to the fat of the moment.
Yeah. Not in my house.
I'm guessing it's still probably bright orange.
Not in my house.
Totally in mine. If it fuels them, absolutely.
Really?
Here.
Extra protein?
I mean, look, it's quick. It makes me feel less guilty. 100%. I'm all in.
Ferro, that stuff, blasphemy.
Doritos protein rolling out this month with 10 grams of protein per serving. Doritos.
Health food.
Okay. Where's RFK?
Seriously, this is not Maha.
He's shirtless,
All
drinking
right.
milk.
Up next on the program, navigating JIP.
It's crazy to me that you see all these narratives being written that central banks are going to tighten into this. If this gets worse than people anticipate, we should be talking about more cuts, not less cuts down the line.
Up next, we'll catch up with Jonathan Pingle of UBS, live from New York City. You're watching Bloomberg TV. Brent crude this morning up by 3%, 103.40 on Brent, WTI around 97, 96, 77, and up by more than 3%. Under surveillance this morning, navigating geopolitical tensions.
It's crazy to me that you see all these narratives being written that central banks are going to tighten into this. I think central banks have learned along the way you don't tighten into energy shocks. I think if anything, if this gets worse than people anticipate, we should be talking about more cuts, not less cuts down the line.
So here's the latest this morning. Traders widely expecting the Federal Reserve to hold rates steady at tomorrow's meeting as the war in the Middle East clouds the economic outlook. Jonathan Pingle of UBS writing, we expect Fed Chair Jay Powell to acknowledge the inflation risk from an energy price shock, but remain balanced in conveying the risks. Jonathan joins us now for more. Jonathan, good morning. Good to see you.
Good to see you.
2 p.m. tomorrow afternoon. How do those forecasts change?
Well, they're, just mathematically, they're going to have to mark up inflation. I think the, I've been, I think the risks to growth are a little sort of two-sided. I mean, I think there's still a certain amount of uncertainty as to exactly how they're thinking through the impact of the oil price shock because they don't know the duration of this shock yet. But I mean, obviously, we could see inflation forecasts getting marked up. My guess is unemployment rate forecasts are more likely to get nudged up than stay the same. But I think for growth, they've had so much talk about this productivity AI miracle. I actually think this is the SEP where they might revise up their longer run assessment. And that actually, in my view, would have them keep growth the same.
Where would the SEP be for the dot plot for the 2026 year, the median dot? Are we pricing out that cut?
Well, the market's certainly trading that way. But my guess is there's enough participants still worried about the labor market that you get a median of 1 cut this year. I mean, even before the February employment report, you had Mary Daly. I mean, even many of the board members using words like vulnerable and fragile for the labor market, and then they get handed, sort of a strike-adjusted minus 60K. Unemployment rate goes back up to 4.44. I think, and this oil price shock is another headwind to the labor market expansion too. So I do think there's a, I can count 10 participants that I think are going to keep a cut.
Okay, so I'm just wondering, I know that the bingo game over at UBS is the number of people who are going to vote for the consensus and the number of dissents. Where do you put your chip?
We put our chips on 3 dissents. I think Bowman's a close call, but I think Governor Waller, after his speech on what he thought would drive the rate cut decision for him, was the February employment report, which was, I think, by all accounts, pretty weak. And certainly, Governor Murin has not been shy about his views.
I'm just wondering how much of a role Jay Powell has right now, given the fact that it might be his one of his last meetings that he's the Fed chair for. Big discussion around whether he will stay on as a governor or a committee member. A question of what he chooses to discuss, how politically he takes this discussion, given that it actually is a key component into forward guidance.
Well, I think at this juncture, where the committee is and all of the uncertainty, I will acknowledge, at least I think you're right. I think this poses one of the biggest communication challenges that he has faced. He doesn't know what's going to happen. He's just been handed a terrible employment report. In 2 months' time, the unemployment rate could be 4.6, 4.7, could be 4.3. Oil prices could be 120. They could be back to 80 or lower. I mean, right. So given the incredible range of outcomes, it's going to be very difficult for him to provide much guidance, take much of a stand. But I do think that, sort of how he nuances this is going to be really important for financial markets, because, the markets are certainly trading this like it's a 2022 shock all over again, pricing out rate cuts. And I'm not quite sure that's what the majority. I think there's enough concern over growth. The starting point for the economy is very different than 22. I do think there's enough concern around the labor market that he's going to want to provide a more balanced message than that. But it's going to be difficult for him, and certainly the politics are swirling around as we were sort of discussing.
What you're painting sounds like a good time to retire, but is there an upside for this administration for Jay Powell to actually stay on?
So, I mean, I have had this conversation with clients, and, it is historically the case that every administration eventually gets to choose a majority of the Board of Governors and their chair, right? And at that point, it's really a reflection, to some extent, this is how politics traditionally influences the Fed through the appointment process. And at that point, it is usually the administration's committee. Now, there's always the certain amount of central bank independence, but at some point, this administration, if they do have their personnel in place, it'll be much more difficult to blame Jay Powell for monetary policy.
Jonathan, that's one way of putting it. It's good to see you. Thank you, sir. Jonathan Pingle there of UBS. Can he avoid the question tomorrow? On March 18th, maybe. On April 29th, I think it gets a lot harder from there. You can't keep punting. At some point, you've got to say where you're going to be next month and what job you're going to have or not.
So stay tuned for the Fed Decides, which is going to be, frankly, the bond market's favorite soap opera. And it does continue and gets a little bit more tense with a question about how he answers that.
The Mike McKees of this world will be peppering him with that question repeatedly, I imagine, in that news conference. Coming up later, Sonders of Charles Schwab, Gil Luria of D.A. Davidson, Greg Daco of Ey-Parthenon, Lisa Hornby of Schroders. All of that in the next hour, right here on Bloomberg TV.
Markets are ruthlessly efficient at exposing what the weak links are.
Most assets should be able to come back within a month to 2 months if and when the war ends.
War has a momentum of its own.
If this only lasts for, let's say, a month or less, we will be okay. There will be a snapback.
Longer term, there is still that diversification story.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures right now in the S&P 500 negative by 0.2%, down by 0.3% on the Nasdaq. Muted price action off the back of this. In the commodity market, Brent and WTI shaping up as follows. Brent crude north of 103, up by 3% this morning. WTI up by 3.5 to 96.82. Ahead of these events right here, the Federal Reserve meeting meeting about 24 hours away. The two-day meeting starts this morning. It concludes tomorrow afternoon.
Yeah, and there's going to be a real question about how they message what ultimately could be a stagflationary shock at a time when the economy isn't doing terribly. And this is something that Alex Altman really pounded the table on. Look, people want to be bullish, and the reason why is because the consumer still has money to spend, and they are spending. The Fed has to face that off with a potential shock that has an undetermined ending point and an undetermined scope, and that, I think, is going to be difficult to do.
And you see that in the numbers coming out of Delta Airlines this morning. An update from the executives over there. Ed Bastian, the CEO, saying this just moments ago. We've seen 8 out of the 10 highest sales days in history in March. The stock is higher by 4%. They raised the outlook for revenue just earlier this morning.
Yeah, the revenue now coming in, this is according to the latest forecast, between 15 and 15.3 billion versus the expectation of 14.7 billion, an upside beat. They're keeping their profits the same. So what does this mean? It means that ultimately they do see higher gasoline prices, higher fuel costs, eating into their profits, but staying the same where they were, because guess what? Consumer demand is so much higher than they had been expecting because of that robust both consumer and business demand. This speaks to the conundrum that the Fed has to face off with, this idea that the consumer and the economy is strong and offsetting some of the oil shock in terms of price, in terms of the pricing.
That's the latest on Delta Airlines so far this morning. The latest on the conflict in the Middle East. More headlines of energy infrastructure being targeted and being struck overnight, waking up to that, and waking up to an important headline from the Israelis as well, that the security chief in Iran has been, in their words, eliminated. Looking for confirmation from both the Iranian and U.S. side later this morning.
Haven't seen that confirmation yet, but what the Israelis are saying is that they were able to take out in this strike Ali Larijani. And this is incredibly important when it comes to decimating how the regime works. What comes next is going to be a huge question, because not only has the supreme leader been taken out, we have yet to see, and the president yesterday cast some doubt on where actually the new Khamenei is actually, and no one's seen him. He said his dad used to speak, no one's talking to him. But Ali Larijani was an important person in terms of security apparatus and also a diplomat, that individual that was talking to the U.S. and part of these nuclear talks.
If you're in the market right now, you've got one question. Who's leading the situation, the war effort in Iran, and does it make it easier or harder to resolve the issues through the Strait of Hormuz?
I think that is a question that we still do not know. At this moment, it looks like this has not resolved the issue with the Strait of Hormuz. But one thing I think it is important, if you brought this up a number of times, there have been vessels that have come through. Chinese vessels, Pakistani vessels, Indian vessels, but really on an ad hoc basis, individuals that are talking to the regime. It's important to remember that the Strait of Hormuz is not closed, it is controlled, which also is not a good look for Washington.
And it's conditional on the flag on your vessel right now. Those headlines bringing this market just a little bit of comfort in the last 24 hours. Coming up this hour, we'll catch up with Sonders at Charles Schwab following the best day for stocks in more than a month. Luria of D.A. Davidson on Nvidia's $1 trillion forecast, and Greg Daco of Ey-Parthenon looking ahead to tomorrow's Fed interest rate decision. We begin this hour with stocks falling and oil rising as strikes continue across the Persian Gulf. Sonders at Charles Schwab writing the following: time is the enemy here. The longer this drags out, the more acute pain points become. Lizanne joins us now for more. Lizanne, welcome to the programme. At the index level, John, pretty muted moves. We've had a 5% decline that ultimately got bought. Is that masking the amount of repricing we're seeing beneath the surface?
It is, John, and there's a number of ways you can look at it. We've, at this program, talked about the average member drawdown level being much more significant than the drawdowns we've seen at the index level. So in the case of the S&P 500, you're right, we've only had about a 6% drawdown maximum year to date, but the average member has had a 16% average drawdown. If you look at the NASDAQ, it's even more extreme. So the NASDAQ's had a little bit more of an index level drawdown, but at the average member level, the maximum drawdown is negative 29%. Another way to look at it is there's about 120 or so names that are trading in a similar band as what the S&P index is trading in, that kind of, 5% up and down band, but almost the same number of stocks have moved by up more than 20% or down more than 20%. So the tails of that distribution are larger than they have been. I think that kind of backdrop is likely to continue.
So picking up on some of the dislocations, people trying to work out if this is a moment to step in, particularly around some discretionary names. We've had headlines from Delta this morning, American Airlines just moments ago, guiding higher for revenue. Lizanne, is this a moment to step in and maybe pick up some of the pieces?
I think at the sector level, I think it's really difficult environment to just make a monolithic call, say on consumer discretionary. I think there's opportunities within every sector. I think it's profit margin stability, profits outlook, to your point about some of the airlines. I think that's really key in this environment. And that's also reflected down the cap spectrum. Unlike last year, this year within the Russell 2000, the profitable stocks are handily outperforming the unprofitable stocks. So I think it's that profitability angle that is really key. And that's where you have to go individual stock by individual stock, as opposed to just making a monolithic sector call.
Can you bleed that stock by stock picking kind of approach into whether you're looking at the equal weight or the tech universe as really driving any kind of rally going forward from here? At the beginning of the year, people were talking about that broadening out, about how more stocks outside of tech would really lead this. Now you're getting a reversal of that. How much are you shifting your view for the rest of 2026?
Not a heck of a lot. I think what's happening now with some of the reversion trades that we have seen, I think that's all about positioning. And I think positioning is really important in this kind of market backdrop. We all know, you certainly do, reporting on it every single day, that trying to gauge what the next announcement is going to be, whether it is from the administration about the war, going back pre-war, tariff-related announcements. We're in this mode of instability right now, and trying to gauge what the trigger points will be is very difficult. But what we can do is assess what the positioning backdrop is. And throughout the course of the last 2.5 weeks since the outset of the war, we have seen a change in positioning. You've seen that de-risking on the part of the systematic funds and the part of the long short hedge funds. We've seen it in retail in terms of individual positions, single stock kind of holdings. Overall, retail has not really pulled back their positioning to a significant degree. You have seen it with the CTAs. So positioning is such that we could get a pretty significant rebound because you've washed out some of that positioning. We can think of the market backdrop as being able to get assessed via the positioning. That goes back to early April last year. Trying to gauge these tariff-related announcements was difficult. But if you looked at positioning, you could see where both the pain trade is likely to be and maybe where there's upside if you get even a modicum of better news.
And Liz Ann, just to sort of build on that, we saw that from the fund manager survey from Bank of America today, that the cash build increased the most going back to the pandemic from February to March. Are you getting more constructive right now?
So the cash build is an interesting one. If you look at the $7 or $8 trillion that's in money market funds, that is a record high level. I think one of the errors, though, is looking at a number like that in a level sense, in an absolute sense, without putting it in the context of the overall capitalization of the stock market. I haven't run the numbers very recently, but when we were at about $7 trillion, not all that long ago, it still only represented about, I think it was 12 or 13% of total stock market capitalization, which is historically very low. So if we think about sort of cash on the sidelines, so to speak, and I don't love that terminology, we have to look at it relative to the overall cap in the stock market, because that's how you measure, is that fuel that if it decides to, shift its attention more to the equity market, how powerful is that fuel? It's less powerful when you're talking about a fairly low share of total equity market capitalization.
Liz Ann, you mentioned catalysts. This year, right now, the focus is squarely on what's going on in the Middle East and the war with Iran. Last year was tariff-induced headlines that potentially moved the market. Can you position your portfolio in the Trump era that ignores Washington?
No, you can't. But you can also, it's also impossible to gauge what those next triggers are going to be, which is why I think you have to focus more on the positioning. I think we've never seen a greater connectivity and short-term volatility being driven by decisions coming out of Washington. There's more, typically there's more of a disconnect between those two. You don't have to kind of draw that dividing line as closely as you do now, but trying to anticipate it, given how unstable policy making has been and just the manner with which policies get announced is a much trickier backdrop, certainly for longer-term investors, but also for traders.
Liz Ann, always good to see you. Thanks for dropping by and making some time for us. Thank you. Liz Ann Sonders there at Schwab. Let's check out the airlines again. So we've heard from two big players. We've heard from Delta and American. Delta first. Delta out this morning, revising their outlook, given an upbeat outlook for the first quarter. That's good news. That stock was higher in the pre-market. Delta Airlines higher by 5%. Some really strong commentary coming from that company. It's not just the consumer, it's corporate travel as well. Surging demand for corporate travel across sectors. That name doing nicely. It's not just Delta, it's American Airlines as well. American Airlines is higher in the pre-market by 4%. They also gave an upbeat forecast as well for first quarter revenue just moments ago. Lisa, I think this is important. So the market's getting some encouragement. More broadly, I think, how's the consumer doing? How are businesses doing? Not just in January, February, after the war, how are they doing in the first few weeks of March? And these companies are telling you pretty well.
The consumer is confident, and the consumer is spending, and the consumer is waiting on those TSA lines and still traveling. The fact that they previously had seen 7 to 10% gains in revenue, and now they're guiding to the 10% level, highlights that resilience and sort of builds off what we heard from Delta, saying that they saw 8 out of 10 of the busiest March days ever so far, given the early quarter read. Question here, what does that mean for profits? It means they probably stay the same because ultimately they are dealing with higher fuel costs. So this goes to the question of, is it stagflationary or just dampening some of the potential growth? In other words, if you get out of the way, the U.S. economy is poised to rip. And right now, sure, there's a bit of a cushion sitting on it, but at the same time, it's not enough to make the stag really the preeminent theme here.
It's one sector, two companies, granted. But we want to know, how are they engaging with the economy? Consumers and corporations right now, are they disengaging because of the headlines of the past 2 weeks? And based on the headlines from those two companies, they're not. Equity futures turning positive, just a touch, by about 0.1% on the S&P 500. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump is continuing to appeal to other nations to help secure the Strait of Hormuz. The president's voicing frustration with countries that have been publicly non-committal about helping ensure safe passage, and even called out NATO for failing to act. Morgan Stanley is warning that private credit default rates will hit 8% as AI continues disrupting the software industry. The bank saying that while AI disruption has yet to impact private credit fundamentals in a material way, elevated leverage and looming maturity walls within the software sector may push default rates to levels not seen since the pandemic. And JP Morgan is planning to add hundreds of jobs in Boston after agreeing to become the anchor tenant in the city's newest skyscraper. The bank expects to hire about 300 employees in commercial banking, private banking, and institutional sales and marketing over the next several years. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the morning calls, plus Gil Luria of D.A. Davidson on Nvidia's $1 trillion forecast. That conversation up next, live from New York City this morning. Good morning.
I think trying to forecast the path of this Middle East conflict is incredibly difficult. It's fraught with difficulty. But what I will say is that it once again highlights US exceptionalism in different formats. Of course, if it goes on for a long period of time, yes, then of course all bets are off and we would probably expect a significantly lower move in risk assets.
That was Alex Altman of Barclays, constructive for the equity market, more balanced, I would say, coming from the man from Barclays. Encouraged by summer headlines that are coming out of the airline industry so far this morning. Delta Airlines, American Airlines, forecasting a better outlook for the first quarter. The first quarter so far, consumers engaging, corporate America engaging. It's an early read on things right now, but a better read of what's happening in this economy, given the risks elsewhere. Things can change quickly, but so far, so good. Equities turning higher off the back of some of these headlines. Equity futures positive by about 0.1% on the S&P 500. On the NASDAQ, just about unchanged. That's the price action. Let's get you some morning calls. First up, Mizuho raising its price target on Chevron to 217, citing higher global oil prices as a positive for the sector. HSBC raising its price target on Johnson & Johnson to 280, saying geopolitical risk and an uncertain macro backdrop could boost the sector. And finally, Stifel reiterating its 250 price target and buy rating on Nvidia, expecting its longer-term opportunity funnel could exceed $1 trillion. Sticking with Nvidia, the chip maker making a big prediction.
Right here where I stand, I see through 2027 at least $1 trillion.
The CEO, Jensen Huang, making a bold prediction as computing demand soars. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the program. I asked this question earlier. Help us out. 1 trillion what? What's he talking about?
Extended visibility for demand into another year. You know, it's as simple as that, really. The 1 trillion is for a range of 2025 through the end of calendar 2027. The prior outlook was $500 billion of demand, specifically for Blackwell and Rubin systems, and it included networking. And that was essentially from October through to the end of calendar 26. The difficulty is when that number hit, and you saw it in the market reaction, right? You know, Nvidia really surged, took the indexes with it. But Wall Street quickly did the math and it came back down. They didn't include those same qualifiers. They weren't explicit on stage or through a regulatory filing about the composition of what's in the 1 trillion. So it's basically cumulative expected sales. And, you know, the thing that bow ties it, the important point is that they still believe they'll be supply constrained in that period. The way that Jensen Huang put it on stage is they'll be short. And the story being that demand through Nvidia's lens is very much intact.
Based on what I just heard from you, Ed, that sounds like it was heavy on marketing and low on substance. What was the big takeaway from yesterday?
Yeah, I think mostly the supply constraint. You know, Nvidia argues two things. That it tells its supply chain and customers many years in advance what it's going to do. And that's true. So they have time to plan for it. Within that $1 trillion forecast, there was an associated pie chart next to it, which showed that 60% of that buying is going to still be the hyperscalers, the cloud computing companies. And that's something that's been very closely watched, because if you look at the sell side reaction, Nvidia is basically a leading indicator that CapEx in the short term will hold up, if its numbers are to be believed. The issue, and I think you guys just showed the pre-market move in the stock price relatively muted. That 1 trillion is very close to consensus anyway. So it doesn't really move the needle in terms of trajectory. It just gives a bit more certainty to lots of people's mind on what the biggest deployers of capital expenditures are going to do. On the other hand, you know, Nvidia keeps telling us that we're supply constrained. They won't be able to get hold of enough GPUs to meet the demand that's out there. Which is a good problem for them to have, but for the rest of the industry, difficult to model for.
Ed, good to see you. Thanks for dropping by and updating us. Looking forward to the programme later. Bloomberg Technology coming up a few hours from now on Bloomberg TV. Luria of D.A. Davidson has a buy rating and a 250 price target on shares of Nvidia. Gil joins us now for more. Gil, welcome. You heard Ed talking about it there, supply constrained. Is that a good problem to have?
Well, not for Nvidia. And in fact, they're working very hard to help all the other participants in the ecosystem figure it out so they can sell more chips. Nvidia's biggest problem right now is that everybody is not catching up to demand as well as they are. And so they've actually gone as far as organizing the whole supply chain around what they're calling an AI factory, which is to say they're going to start coordinating all of the different participants in building out data centers on their platform so they can be more coordinated, so there won't be as many delays in data centers. If there is not a warm shell in a data center ready for GPUs, they can't sell GPUs. So now Nvidia, beyond just making its own product, has to help everybody else make their product in time so they can sell more GPUs.
Gil, did it bother you that we don't have a lot of clarity around this $1 trillion number that was massive but didn't really offer much visibility?
You know, I'll take the other side of that, which is to say for the longest time, Nvidia just guided 1 quarter at a time. And that meant that investors didn't really have that much visibility going forward. In October, they extended that for 12 to 15 months. And now they're extending it out another 12 months. That's actually very helpful. Now, is it a specific number with qualifications? Maybe not. But keep in mind, consensus estimates for next year were $460 billion, and he just added $500 billion. So it doesn't matter how you qualify that number. That means that Nvidia expects to grow more than 30% next year, not just this year, but next year. But part of the problem is the market is not believing it. If Nvidia is trading at 22, 23 times earnings, which is basically a market multiple, and on the very low end of their historical multiple range, that tells you the market just doesn't believe it. And Jensen Huang is pushing Rowe. He could have said $2 trillion for next year, and the market's just not believing it. Now, he has a lot of credibility. He's gained it over the years, but the market is saying we are skeptical that this great data center build out will continue into next year. The good news for Nvidia shareholders is the closer we get to that, the more Nvidia can show that it is actually going to grow into next year. That's the upside to the stock.
What was Olaf doing on stage with Jensen Huang?
They were trying to illustrate that humanoid robotics and other types of robotics are making huge leaps forward. So they brought Olaf from Frozen to life. They had a music video recap. It was a very high production event yesterday. NVIDIA is expanding well beyond the GPU. That's the big takeaway from day one of GTC, is that really up until now, it's been GPU and CUDA and maybe networking. And now they've expanded that a lot. So multiple software options, multiple networking options. They're going to start selling CPUs individually. And the most important takeaway from yesterday is the addition of the Grok chip into their data center systems. That will bring them to such a level of inference productivity that's going to extend their lead over Broadcom and AMD. That's the biggest takeaway, because there were a lot of concerns that, Broadcom, AMD catching up with GPUs, custom GPUs, ASICs. And what NVIDIA just did is, by integrating Grok, they're saying, no, we're going to extend our lead. The cost per token on our platform for inference is going to be a fraction of everybody else. The productivity per second for inference is going to be much better than our competitors. So that was the big news yesterday.
Gil, appreciate your time. Thank you, sir. Gil Luria there of D.A. Davidson. I'm struggling to find what the takeaways were from yesterday, given your question.
That was Lisa's takeaway.
Well,
I was just really struck by the fact that they had this whole build-up about the creation of robot Olaf and then bring it to the stage. The takeaway was ultimately they're moving into robotics, they're moving into self-driving vehicles, they're moving into deploying this in some sort of cheaper version throughout a broader swath of the economy. That's the goal. That's how they get to $1 trillion. A lot of the other details kind of not exactly
Market's
clear.
Just not buying it at the moment.
Yeah.
Stock really has stalled. That rally has stalled out big time over the last 4 months. Nvidia this morning higher by 0.2%. Up next, Greg Daco of Ey-Parthenon on tomorrow's rate decision, and Danny with your morning movers, the airlines in focus. The airlines in focus this morning, the equity market turning higher off a better outlook from the airline industry. We'll get to those names in just a moment. Futures positive by 0.1% on the S&P and on the Russell, small caps turning around. We were negative across the board about an hour ago. That's turned around in the last 60 minutes. Let's get you some single names, some morning movers. Danny has more. Hey, Danny.
John, let me get you those airlines. Again, the results looking strong for all of them, despite the fact that there are higher fuel prices and concerns about consumer appetite. It is there. Delta, JetBlue, American Air, all of them pointing to a more positive outlook to come. Yes, fuel prices are up, but that is not stopping spending. Just looking at Delta, for example, it now sees its revenue growth in the first quarter between 7 and 9%. Previously, 7% was the high end of expectations. So that's a positive sign. Elsewhere, Uber and Lyft, both the rideshare companies, are moving on the upside. Both of them announcing a partnership with Nvidia to expand an autonomous vehicle fleet of cars using their technology. Uber looking to expand into Los Angeles and San Francisco. Finally, wrapping things up with the company that was also on the upside yesterday, Nebius. This is the Neo Cloud. Yesterday, we learned that Meta had signed one of their biggest ever single contracts with the company to use more of their facilities. Nebius this morning putting into the market a just under $4 billion convertible debt offering, a dilutive event, so that tends to move shares lower. So they are moving lower, just under 7% this morning in the pre-market, John.
Danny, thank you. Looking forward to the show alongside Matt Miller, Danny Berger at about 9 a.m. Eastern Time, guiding you into the open about. We're overweighting the headlines coming out of the Middle East for good reason. They're important. The airlines have been beaten up over the past few weeks with higher fuel costs in mind. This update from them is really, really important. Consumers still engaging with travel, not backing away. Corporate America's not disengaging either. This headline, they see surging demand for corporate travel across sectors.
To me, this is arguably one of the better tells on the overall economy, understanding that, yes, the people who choose to fly tend to be higher income, so it isn't necessarily representative of the overall average economy. Nonetheless, the confidence that people have to travel and the fact that everyone who I talk to in the business world is traveling that much more because of the uncertainty, not necessarily less, gives you a sense of why some people are saying, hold on a second, are things really as bad as expected? Alex Altman saying that the increase in oil prices hasn't had the negative pass-through to the U.S. economy as much as people had expected.
They're weathering the storm right now, but still, this headline that they saw a $400 million spike in fuel costs in March. If this continues, can they withstand that for much longer? When you think about the crudes coming out of the Middle East, it's medium and heavy crude. More than half of that percent, more than 50% of that is to make jet fuel. These prices are going to go up higher, like we see in diesel today in the United States, above $5 a gallon. At what point does then it start to hurt?
Right now, the stocks are going higher. Delta up by 5%, American up by more than 4%. A two-day meeting beginning in Washington, D.C. later on this morning for the Federal Reserve. The war in Iran throwing fresh uncertainty into the economic outlook. Bloomberg's Ender Curran joins us now for more. Ender, set the stage. They get around the table. It was already confusing enough, and now they've got a massive risk emerging in the Middle East.
Yeah, it's going to be an opportunity now to get a new narrative from the Fed, John. The first time we'll hear from Chair Powell in terms of how Fed policymakers are thinking about the Iran shock. Are they going to view this as the classic supply-side shock, near term, look through it, without, of course, mentioning the word transitory? Or will he give a hint that perhaps bigger picture, they're going to be worried about how higher oil prices will impact consumers and businesses, and then, by extension, at some point, the Fed might actually have to start resume cutting rates down the road. But near term, for this particular meeting, no change in policy expected. Keep an eye on their new growth and inflation forecasts. The new projections for interest rate moves by the FOMC members will be interesting. And, of course, dissents. See where people like Governor Waller come down, whether or not he pushes for a cut if they do stay and hold. Governor Myron is expected to dissent. And keep an eye on Governor Bowman, too.
Governor Waller, on this programme, had already said it was a coin flip, came onto the programme on Payrolls Friday and basically said, you get another weak print, and ultimately I'm going to lead in one direction versus the other. It looks like he's going to vote for a rate cut. And the other question we've got are questions for the chairman in the news conference. His future. And what do we know about what's going to happen here over the next few months at the top of this institution?
Still a lot of uncertainty. The political story is absolutely there, John, as you mentioned. We had, of course, the big court ruling last week quashing those subpoenas against the Fed by the DOJ. On paper, that suggested maybe a sigh of relief for the Fed in terms of that particular investigation, but we know the DOJ will push on with that. They've said they will appeal. One wrinkle that came out of those court documents, John, was some commentary in there, some exchanges between the DOJ and the Fed attorneys, whereby it became clear that Chair Powell has said he can't really leave the Fed until this investigation plays out. Now, of course, his term as chair will end in May, one way or another, but his term as a governor of the Fed runs until January 2028. And these court documents show that so long as the criminal investigation is carrying on, he is not going anywhere. That, of course, is very important in terms of allowing President Trump the opportunity to appoint someone to replace him. He has said publicly he wants to stack the board. And, of course, it may have implications for where monetary policy goes near term as well. So there's a lot of both economics and politics at play in this Fed meeting over the next few days.
And Karen, thank you, sir. Down in Washington, D.C., there was an off-ramp available to the administration, and ultimately, nobody's taken it.
Yeah, they are saying that they're going to appeal the Supreme Court's decision, that they can't go forward with this, which, again, is a question. Does this mean, to Annmarie's point, and you raised this, and I thought it was a really salient one, does that mean they want Jay Powell to remain so that he can be sort of the whipping post for all concerns economic?
It's a bit odd, isn't it?
I mean, it doesn't make any sense.
You've got your nomination. He's lined up. Senate is going to confirm him. We've heard from all the key players. They want to confirm this individual, and you're holding things up. Why?
So there are two ways to read this. On one hand, you could say you just can't let it go and you want to win, and it's sort of just this visual win, and that is what we're seeing. And number two, there's a feeling that maybe they want to push this off as long as possible because this is a difficult period of time economically to make any kind of definitive decision, and they want to have a fall boy, and they have one in one person who's at the head of at the Fed.
It gets harder for Chair Powell to punt. Penultimate meeting. What's your future? What's the leadership of this institution look like? Succession planning. You're not in charge of all of that, I get that, but ultimately, where are you leaning? What are you doing? Where are you going to be come June?
And a couple months ago, Jay Powell became much more political with that announcement that he made, that recorded announcement on a Sunday night. Does he revisit that tone and say something specific about this? If he doesn't, that in and of itself is going to be a signal. Is this sort of, misdirection on purpose, or is this ultimately he just hasn't decided yet?
Toothpaste is out of the tube. Now, he didn't start this, but he chose how to react right before the opening bell Sunday evening. The opening of markets in Asia, he himself engaged politically in a way that I think people still question to this very day. I think it makes it much, much harder for him now to back away from any conversation about his future, given how political it's become. And you can't, on the one hand, say, I don't want to engage in the politics, and the next moment say, I'm happy to engage in the politics. Once you start doing that, got to be consistent.
Right. And he could just be asked a question that has nothing to do with the actual personalities involved and just what would happen in these cases. The Wall Street Journal editorial board is actually out with a piece today, though, and says to the administration, take the hint. This may be a loss, but actually for you it could be a win, and it's an off-ramp, which is why I started to think about, well, why do they want maybe Jay Powell to stick around?
It's odd they're not taking that off-ramp. Greg Daco of Ey-Parthenon doesn't want to talk about this. He wants to talk about the outlook. Given our higher headline and core PCE inflation forecast, we have revised our baseline to show only one 25 basis point rate cut in 26. Greg joins us now for more. Greg, good morning.
Good morning, John.
We'll sprinkle some politics in, no doubt. Clearly, this is a really difficult moment for the Federal Reserve. We're off the back of a really weak jobs report. We can get into that in a moment. And we've got the potential for an inflationary shock as well. How do you think that mix comes up in the outlook tomorrow?
I think in general, what it will show, the outlook from the Fed's perspective, is that we have the greater risk of a stagflationary scenario. And that is problematic for the Fed because we know that a lot of policymakers before the report for employment in February were essentially leaning more hawkish. And even Governor Waller, as you mentioned, was leaning towards a 50-50 coin flip as to whether he would dissent if the Fed held rates constant. So we have this hawkish lean. And what's likely to happen is that the Fed is going to be on pause. Why? Because they do not like this type of stagflationary environment, and they do not want to preemptively react to either inflation moving up or growth moving lower. And with policy being close to neutral, they feel like they're well positioned to essentially wait and see the data. So that's why we're not expecting any move over the course of the next few months by the Fed. They're going to be very data reactive, and they're going to wait out to see how this plays out.
I don't get the sense that anyone's particularly excited about the actual decision, about the fact that they're going to remain on hold, and that's pretty much a given. They are curious, though, about the statement of economic projections. Yes. How seriously do we have to take those? I mean, ultimately, isn't it just at a time like this, throwing a dart at a dartboard?
It is a bit throwing a dart at a dartboard because we don't know what the assumptions are going to be, and we don't know how each policymaker is going to look at these assumptions. We had the same type of issue with tariffs. What were the tariffs assumptions by the different policymakers, and how did that influence the median? So if you consider today's environment, what's key to factor is where oil prices are going to be in 3, 6, 9, and 12 months' time. Where are interest rates going to be in that environment, and how is economic activity going to react according to that? I don't think we have a lot of clarity. I think what's even more important is how the statement will be framed. There's going to be more focus on downside risk to employment, upside risk to inflation. Let's not forget, in the minutes from the January meeting, there was a very close call as to whether we would have a two-sided statement putting back on the table the possibility of rate hikes. That should not be discounted in this environment.
Do you think that's warranted? I mean, if you look at history, oil price shocks typically are disinflationary or outright deflationary over the long term. It typically torpedoes growth when it is for a prolonged period of time at a certain level. And I'm talking more $150 than $100 a barrel in today's world. Do you think that it is appropriate for them to put a rate hike back on the table?
I don't think it would be appropriate right now, but I think we have to consider the environment in which we've been evolving over the last few years. I wrote a recent note on the FOMC saying once burned, twice cautious. And the memory of the burn from 2021 and 2022, when the Fed said the tariff shock and the post-COVID shock were going to be transitory, was essentially misguided because we saw this pervasive inflationary environment. Today, we are in an environment where there are a number of supply constraints. What do supply constraints do? They limit your output, they push up inflation. add another geopolitical shock where oil prices are rising, and they will filter through into transportation costs, into air travel, and that will lead to a more prolonged, longer tail in terms of inflation. And so while rate hikes are not necessarily optimal right now because monetary policy is arguably close to neutral, there could be an environment in which inflation proves more persistent and where some policymakers argue that we should actually have higher interest rates to bring inflation back down consistently and sustainably back down to the 2% target.
Greg, news conference scene. I'm Michael McKee from Bloomberg TV. Chairman Powell, will the next meeting be your last meeting? How does he respond?
I don't know, Mike. I think he's going to be very cautious. He's going to want to stray away from that. It's a bit of a paradox because he did come out quite openly when there was the initial DOJ probe into the Fed and his testimony to Congress. We now have, as you were saying to Annmarie, an off-ramp possibility with the judge injunction that the probe may not continue. And so this is a key question, in terms of Fed Powell's future. We have to remember that his term as governor lasts another 2 years beyond the end of his term as Fed chair. We also have to remember that the head of the Fed and the head of the FOMC can be two different individuals. So we could very well be in an environment where past his term as Fed chair, the FOMC just continues to go with Fed Chair Powell as governor, but then head of the FOMC, which is a key decision maker when it comes to policymaking.
I imagine he avoids the question. Base case of many people, he avoids the question. I also imagine it's not hugely consequential if he does avoid the question at this meeting. Does it start to become consequential for anybody, for market participants, for Fed watchers, when we don't know the future at the top of the Federal Reserve?
Absolutely, because there are a number of potential scenarios. He could leave, he could stay on as a governor, he could stay on as a governor and as head of the FOMC. So for market participants that are trying to gauge the Fed's reaction function in the type of environment that Lisa was just describing, where you have the stagflationary shock and it's uncertain what the optimal policy decision is going to be, uncertain as to how transitory the inflation shock may be. Yes, it is key for market participants to know who is going to be the leading voice around the table when it comes to making decisions. We know this is a vote, but the leading voice from the FOMC chair is very, very important.
Do you think market participants are looking at this and thinking the administration wants someone they can blame potentially some economic fallout on?
I really don't know the answer to that question because it's unclear as to what will be the trajectory over the coming months. We know that policy tends to pivot fairly quickly. We know that we're in an environment where there's a lot of uncertainty when it comes to Fed policy. There's a lot of uncertainty when it comes to geopolitical uncertainty. There's a lot of uncertain geopolitical policy. There's a lot of uncertainty when it comes to tariffs. And we have to remember this. This is an environment where it's not just about what's happening in the Middle East. We still have in the background an environment where you have historical tariff rates. You have a historical reduction in immigration. You have AI that's leading the boom in terms of productivity growth. So you have all of these different elements that are coming at the same time. And we tend to be focused on just one thing. But the reality is that there's so much uncertainty that I think it's very difficult for market participants and for the administration to calibrate what they're going to do next in this type of environment.
Greg, it's good to see you. They had enough on their table already. They got one extra now. Greg Daco there of Ey-Parthenon. I don't want to inject drama where there isn't any, and there doesn't need to be any. I don't think it has to be a dramatic news conference tomorrow. It could well be a boring one. I imagine that's the goal of the Federal Reserve and the chairman going into that meeting tomorrow. But by the time you get to the end of April, which should be his last meeting at the Federal Reserve, you should be in a position to provide some guidance. And I know a lot of this is out of the Federal Reserve's hands right now. There was an off-ramp. The administration didn't take it. The ball's in their court.
At the April meeting, he will have to answer on some level. There will have to be some more conclusion, and maybe he can wait it out until there is more clarity about who potentially could be put in. In the meantime, they have a lot of drama in terms of what they have to characterize as boring. I mean, they have to characterize an economy that is absolutely a jumble, with on one hand a consumer that does appear to be strong, on the other hand an oil shock that could potentially torpedo everything. And they want to come out and be as boring as possible. Good luck.
Do nothing, say little, and appear to be non-committal. I think that is the goal, ultimately, right?
Sounds lovely.
Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Iran striking new targets across the Persian Gulf. The UAE suspended operations at the Shah natural gas field due to a fire, while a drone attack temporarily shut the Fujairah port. An Iraqi oil field and a key Emirati port were also targeted. American Airlines rising after projecting a more than 10% year-over-year revenue increase in the first quarter. The outlook comes despite the company losing hundreds of millions of dollars during January's winter storm. And shares of Delta also trading higher, up 4.4%. The company issuing a more optimistic sales target for the first quarter after bookings accelerated into March. And Bank of America releasing its March fund manager survey showing sentiment has begun to turn bearish after months of near-peak optimism. Global growth optimism among respondents plummeting from 39% to 7%, while cash levels surged, tracking their biggest jump since the pandemic. And rate cut hopes now sitting at their lowest level since early 2023. But so far, no one is pricing in a recession. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, Lisa Hornby of Schroders drops by on finding opportunity in fixed income from New York City. You're watching Bloomberg TV.
If we had known that you were going to more than double from the December low in oil to where we got to a week and change ago, would you have really thought that stocks would only have been down 5%? It speaks to the resilience of the market. It speaks to the resilience of the economy. The fact that you're going to get double-digit earnings growth this year speaks to the fact that markets can move higher.
Does it speak to resilience or complacency? That was Emanuel of Evercore. We have thrown a tremendous amount at this market, and it has stood up really, really well. Futures positive right now by 0.2% following an upbeat guide coming out of the airlines this morning from both Delta and American Airlines. Up by 0.2 on the S&P, on the Nasdaq up by 0.1. That's the price action. This is the trading diary as we count you down to the opening bell about 40 minutes away. At 11 a.m. Eastern Time, the President meeting with the Prime Minister of Ireland. On Wednesday, PPI data plus a Fed rate decision and Chairman Powell news conference. On Thursday, rate decisions from, wait for it, BOJ, BOE and ECB, and another round of jobless claims just before Friday going into the weekend. Treasuries holding steady ahead of tomorrow's Fed rate decision and a whole lot more. Lisa Hornby of Schroders writing the following. Fixed income yields have become more attractive, increasing opportunity for building a diversified income-oriented portfolio. Lisa joins us now for more. Lisa, good morning.
Hi.
So the bond market's a buy after the backup of the last few weeks.
I wouldn't say monolithically, but I would say there are definitely components that have...
Selectively.
Exactly.
Where would you select?
Well, let's just start with this. Yields are higher than they have been in the past, and I think that's what's made this crisis a little bit more unique, is that actually, as rates have gone up, we're actually seeing more yield-based buyers come in, and that demand is there.
So they've stepped up.
They have stepped up. We're seeing that in the survey data. Obviously, the cost of hedging in certain jurisdictions has gotten a little bit less onerous, or making the all-in relative value of the U.S. market more attractive. And that's something that we were struggling with a bit, 12 months ago. And now we're starting to see that demand come back.
And that's for treasuries, long-end treasuries you're talking about specifically.
And credit as well.
So they're meeting a slew of bond sales. I mean, really, just a huge glut of issuance that we've seen over the past couple of weeks, particularly investment-grade credit. And we've seen spreads start to widen out. Can you explain why credit markets seem to be so wide open, so receptive to all of these potential deals, at the same time that everyone says that they're so worried about private credit?
So I think there's a couple of things. First of all, the yield-based buying is a real thing, right? So even these deals that have come, and people were worried about supply. There's obviously going to be massive supply in tech this year, and already it's started. But people were worried about supply, but also, the yields on the index, depending on which index you look at, 5.25%, 5.5%, 60% of the credit of the market is yield-based buyers. So all that matters is kind of the line in the sand. If you can achieve a certain objective and a certain yield objective, then you're coming in to buy. Does that mean that spreads are going to go in a straight line up or even down? No, I think that there's going to be puts and takes, and certainly this year. And part of the rest of the comment that you started with was there's a lot more dispersion in markets, and so this is a much more idiosyncratic issuer selective market than it has been in the past. You know, there are some years where it's just beta. You just want to buy the market and that's it, or you want to sell the market and that's it. This year, it's about doing your stock selection homework and making sure you understand the underlying fundamentals of the issuers out there.
Earlier this year, among all asset classes, there was a feeling, go outside the United States, that maybe there was a threat to the U.S. dollar dominance, et cetera. It seems like that has completely gone on its head. And I wonder how much you're seeing yield-based buyers come back to the U.S. from overseas that had been looking for opportunities in emerging markets in Europe and elsewhere.
So I can tell you anecdotally, it's funny. We think a lot about those investors, especially at a British firm. We have a lot of non-US based investors. And I was talking to a Japanese client recently, and yields in Japan have clearly gone up quite dramatically. And one of the things we've been talking about is, hey, are you still interested in the US market, or is it now more attractive for you to buy your own market? And he said, look, it's definitely become slightly more attractive, but at the end of the day, Japanese credit markets are very small and not diversified. We need to look at the U.S., and we need to continue to do that. And so, yes, there may be other alternatives, and certainly the cost of hedging and things like that, rates moving higher abroad is a big deal. But at the end of the day, you're going to want to build a diversified portfolio. If you have dollar liabilities, you're going to want to match them with dollar assets. So I think there's a whole host of reasons why international investors still look at this market.
And this is where the depth is, that's for sure. I want to finish on this. Of the conversations you have across regions right now, do you sense a difference between different regions based on how they're experiencing this shock coming out of the Middle East and their attitudes to it?
Yes. I mean, certainly some areas are more exposed directly to the oil and gas markets. They are more sensitive to importing demand. I mean, you're probably talking more about developed markets. I think that's clearly true. I think it's true in emerging markets as well. I mean, you have certain energy importers that have become under quite a lot of pressure, just given terms of trade are going to be shocking more negatively. On the flip side, you have energy exporters, or those who are less dependent on the energy import sector, and I think they're actually doing quite well and actually well positioned. So, yes, on all fronts, in terms of what it looks like for the consumer and economic growth, different impacts depending on where you are, and also in terms of what it looks like for the region as a whole, just the business and the industry there.
That shock cascading through the global economy. Lisa, good to see you.
Great to see you.
Lisa Hornby of Schroders. Quite a morning so far. The strikes continue in the Middle East. We've seen the damage done to energy infrastructure, some key targets in Iran taken out by the Israelis, confirmed by them a little bit earlier. But still, the backdrop for the American economy in focus, a better story coming out of the airlines, American and Delta. So far this morning, futures just about positive. Big day tomorrow, a Fed decision just around the corner. Looking forward to covering it with you from New York City this morning. Good morning. This was Bloomberg Surveillance.